What a sad state of affairs. I didn't really know if I was going to do a room today with the really humanitarian disaster, the craziness that's going on in the Ukraine. It's like the world's gone mad. I was talking to Three Aces this morning, and he'll talk a little bit about what he's seeing. You know, we talk about, we're in here to try to help each other. It's a great community we have. And I was texting with another well-known participant in these rooms, a really smart guy, I'd rather not mention his name. And he just said he didn't feel like talking about stocks. He's from Eastern Europe. He's actually from Russia. And I know where he's coming from. And I thought it was pointless to have yet another room about the Ukraine. There are countless rooms in Twitter spaces about the subject. There's this poor fellow, Walter. I think he's actually Ukrainian. He does a good job, but I think it's his full-time job now, 24 hours a day. And my simple take is, and I've said this many times already, I don't know what's going on. I don't think anybody does. No one I saw really predicted this, the way it's gone down. And, as regards markets are okay with pricing risk, but they're unable to price uncertainty. And that's what we have right now. And anyone who claims they know, I want to be a little bit humorous, add a little levity as I usually do, but it's kind of hard given everything that's going on right now. All the retired armchair virologists, the expert immunologists, they've all become experts in nuclear weapons and international relations. And yeah, I listen to these rooms, I'm sure you do, and nobody knows. And I think the world's in a scary place right now. My own 2 cents in the for what it's worth category, and I think I've tweeted this out a bit. Forget about, I think it was in the room with Sohaib and the Kenyan Oil Mafia yesterday. They were talking about, heads, peace breaks out, tails, we're all water vapor. Okay. Ask Goldman Sachs to price up an option on that. But forget about that. Let's assume he doesn't do anything totally crazy. Forget about nuclear weapons for a second. And let's say he just decides to kind of hang out in the Ukraine. And maybe he doesn't go kill as many people. I'm kind of giving you a less bad scenario. So let's say he doesn't do nukes. Let's say he doesn't go on a rampage killing people all over the place. Let's say it's a tougher road for him than he thought it was going to be. Let's just say he hangs out. He doesn't go after Poland and Moldova and Belarus and all these places. Well, I tweeted out something this morning. I tweeted out a few things. I strongly urge you all to watch the video. I just discovered this yesterday, courtesy of Alan, by Peter Zahan. I think it's 32 minutes. You can watch it on double speed. He's written a couple books, and I don't think he's a tinfoil hard hat helmet type of guy. But he was just pointing out how, he thinks Putin will go after all these other countries. But even that aside, and I hope we get Abe to come in here and talk about what's going on in the materials world and with metals and steel, because he was throwing some real bombs the other day in one of our rooms. You just look at the supply chain disruptions. We know about energy, grains. You look at how much of steel's produced by East European countries, so on and so forth. If I were Putin, the way you really inflict pain in the West is not by blowing up. That's crazy, like opening fire in a nuclear reactor, seriously. But imagine if he just kind of sits there and just sits there and doesn't do anything, and just time goes by, and the price of oil will go up and up and up. You already see some ungodly percentage of oil exports out of Europe, out of Russia's not being taken now because of insurance issues and whatnot. And I don't know, it's 4 million barrels a day, 5 million barrels a day, whatever the number is. You already see what's starting to happen with the oil price. But imagine this continues. And imagine what you've seen in grain prices, this continues. So people don't have energy, people won't have food. That'll be good for capital markets. So if I was really evil and diabolical, and say whatever you want about Putin, he ain't stupid. The easiest way to screw the West and try to undo U.S. hegemony, dollar hegemony, cause financial markets to crash, have the oil price keep going up. And even though, as we've all read recently, what is it they say Russia is a gas station with a farm attached to it or whatever, the GDP is hardly any bigger than Spain or Texas. Well, they're certainly punched above their weight class, but because between the amount of oil, natural gas, grains, other minerals and metals, their abilities, nuclear capabilities, the bomb, cyber warfare. I mean, they're punching way above their weight class. So yeah, we can talk all we want about the GDP keeps going down and the population is shrinking and blah blah blah. But one of the things I read that resonated with me is if he's going to try to take a shot at the world, now's the time to do it. So I don't know. It certainly just breeds uncertainty, and how this can affect, when coming back to the vulgar mercenary issue at hand about how do we protect our net worth or increase our net worth. Kind of feel empty even talking about this, but again, I think this is better use of our time than having just another room on the future of Ukraine and Russia, because there are enough of those rooms. We don't need to add to that. I just think it's really hard. And there was one, Alan, who's a friend and is in these rooms all the time. He sent me something this morning. See if I can find it here. I tweeted it out. It was just ridiculous. I urge you people. I tweeted this out at 45 minutes ago.
George, I'll put it in the nest now, George, for everybody.
Yeah. The one from 45 minutes ago. Rising risk of a nuclear apocalypse. I mean, you can't make this stuff up. Okay, I mean, 3 A's, you can put it in there. I'm not going to read the whole thing. It's just a few paragraphs on the front page. Says Vladimir Putin has now committed himself to orchestrating regime change. Anything less would be seen as a defeat for him. Blah, 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 blah. Oh, here we go. Although there is a huge margin of error around any estimate, subjectively, we would assign an uncomfortably high 10% chance of civilization. I'm sorry, I'm laughing. I'm laughing not at the seriousness of the situation. I can't believe that someone would publish this dribble. We would assign an uncomfortably high 10% chance of a civilization ending nuclear war over the next 12 months. These odds place some credence on Brandon Carter's highly controversial doomsday argument. Even if World War III is ultimately averted, markets could experience a freakout moment over the next few weeks, similar to what happened at the outset of the pandemic. Google searches for the nuclear war are already spiking. Here comes the money. Here comes the money shot. Despite the nuclear war, it makes sense to stay constructive on stocks over the next 12 months. If an ICBM is heading your way, the size and composition of your portfolio becomes irrelevant. Thus, from a purely financial perspective, you should largely ignore existential risk, even if you do care about it greatly from a personal perspective. Bottom line, the risk of Armageddon has risen dramatically. Stay bullish on stocks at a 12-month horizon. I mean, boys and girls, this is not The Onion. This is not Babylon Bee. I mean, this rubbish bank, I don't know what the hell this thing, BC something or other. I mean, can you believe this? This is what it's come to. This is like, you can't make this up. All right, enough of that. So this is just stream of consciousness. I decided to do this room 2 hours ago, and I'm kind of winging it here, but that's usually when I'm most creative. We are going to talk about a variety of topics today. Out of character for me, we are going to talk about crypto, but we're not going to let this room degenerate into a complete food fight over crypto, as is often the case, but rather the angle now of geopolitics and Russia and how that might inform the debate around crypto. And we have our good friend, my good friend, Mt.Gox'ed. That's his Twitter handle. He's going to talk about crypto. That's the last thing he's going to talk about. I first want him to bring his perspective as a Dane, recognizing that probably 80% plus of the people in this room are Americans. Sort of the view from Denmark, and as a European, what's happening to energy prices in Denmark and surrounding countries, what's happening to food prices, what's the average person in the street thinking about all this. So just a view from Europe, because, I mean, the more you read, and again, we had a great speaker in the Canadian Mafia room yesterday, and so I forget the guy's name, was talking about, we really should read other sources, and it's really helpful to read other sources. The fellow from Saudi who was saying,
His name is Amir.
yeah. So read other sources. I routinely read other sources. I think the media in North America is just ridiculous. But to get the perspective from what's going on in other parts of the world, so I think Mt.Gox'ed would be very helpful for sort of giving the European perspective, and then talking a bit about his view on markets, because we've known each other for almost a year, and we have similar views on markets. He's a fully paid up member of the Kathy Wood fan club, and then talking about crypto. He and I first met over crypto. I don't say this modestly; it's a fact. We were the ones responsible for Jim Cramer running a couple stories on crypto. We fed everything to him, but we were disappointed how it came out in the end. We tried to engage some other publications, be it the Wall Street Journal, the FT. We've done a really deep dive on this, but I think the view we have has just been complete regulatory capture and total failure. Maybe what's happening now will finally force the authorities to get off their ass and do something. Who knows? So, any of that, man, Cox, my good friend, you and I spoke a few minutes earlier this morning. Talk about whatever you want, but again, I know your first love is to bash crypto, and you and I want to do that, but I generally don't talk about crypto, but I'm going to allow you to talk about it today. But really, first, let's just start with what's going on in Europe, how you're seeing the situation, not really, less from a financial markets perspective, more just from a real life perspective, and then give us your views on markets, and then talk about crypto. So, Mt.Gox'ed, with that, the floor is yours.
Yeah, so as I pinned up there, natural gas in Europe is literally 13 times higher than in the US. And, because oil is up so much, it's become so expensive to tank your car now in Denmark that they're talking about giving helicopter money, $500 to each household to afford the rising heating bills and gas bills. Like, it's probably going to be even higher than 500, but they're going to give every household $500 to cope with the increase in commodity prices, or natural gas and oil specifically, but also just like wheat, for instance. Russia is the number one producer of wheat, and they invaded a country which is top 5 producer of wheat. So the supply of wheat is going to get cut off, and that's going to create a disaster in Europe. And you have all these other commodities where the supply is also being cut off, which means that you go to the supermarket, everything's suddenly going to be like 20, 30%, 40% more expensive, like pretty much overnight. And that's what we're looking at here in Europe.
Thanks, Bangkok. So I'm just curious, because you're in our rooms all the time. You've lived in America. You read the American press. Could you explain to us a little bit, like, kind of the view from Denmark or other European countries? There's a view that the U.S. is largely to blame for some of this because we were too aggressive with the NATO expansion, et cetera, et cetera. I've been shocked to learn that German attitudes are more pro-Russian than I thought. I'm just kind of curious, what's your view in terms of how the Danes are thinking and the typical continental European is thinking about, what the role of the U.S. in this, and then more importantly, in NATO, and more importantly, how it's going to play out. You got any thoughts on that?
Not anything that you probably haven't discussed, but I just note on the Germans that there was done a study where they actually trust the Russians more than the U.S. Like, just the average German trusts Russians more than the U.S. Like, that was a few years ago. So that's just to give you a sentiment on Germany. But we can go into the whole Russia thing. I don't know how deep I should go, but it looks like Putin...
Well, first of all, embarrassing as an American, I got to get the map out, but you guys aren't that far away from Russia, no?
No, it's Europe. Like, there's a war in Europe now, Eastern Europe, and where we're like 2 countries away. Like, there's like 2 countries between us, or 3. It seems like he wants to recreate the Soviet Union and just shut everything down. Like, capitalism is dead, essentially, in Russia for the next couple of years. That seems to be his plan. And if that happens, like, the world is going dark for a couple of years. And that's my outlook anyway, that we're going to have a severe decline in everything for the next couple of years.
Is the problem starting to be, if you're the everyday man in the street, are you really starting to feel it yet? Because here in America, the gas price has gone up a little bit. but it was already going up, for months years before this ever happened, but the food price started to go up at an accelerated pace, even though they were going up before. So, other than reading in the newspapers, like, as a Dane, would you notice anything different?
No, but like the gas is up double from 1 year. Like it's literally up 1x, 100% up in 1 year. Like people can feel it. Like people don't go and visit family and friends because the gas is too expensive. And you go to the supermarket now, everything's like 20-30% more expensive. They already pass it on to the consumer. I went to buy, like last week I went in shopping. I was like, damn, is it like this bread really costs this much? Like it's insane. The wheat shortage is can be felt, and the supermarkets are going to go parabolic in pricing, and it's unfortunate.
Yeah, I couldn't agree with you more. All right, let's. You know what? Why don't we? Let's move on to crypto briefly, and then as we always do, we'll open it up and we'll get everybody engaged. A lot of really smart people in the room. I see a lot of friendly faces in here. So, Mt.Gox, maybe just without, because I know this is a dangerous thing to do, but like let you go on crypto because you and I will just talk forever. But maybe just state sort of where your head, give the conclusion first, like where your head's at on crypto, and how do you think crypto is impacted or playing a role in what's going on with Russian operations right now, and are you at all hopeful of any acceleration and implementation of regulatory measures?
Yeah, just a quick context. Like I've followed crypto since 2012. I was on Silk Road and stuff when BTC was $10. I remember seeing it at $10, and I actually believed it at one point. I drank the whole Kool-Aid. I was like, "Oh, this is the future and stuff." And then I learned how the world worked, and then I realized that there's a lot of problems, and it's basically hot air. But essentially, this summer, when the Colonial Pipeline was hacked, the DOJ put ransomware on the same level as terrorism. So the highest level priority of so they have the entire toolkit out to stop ransomware. And ransomware is not really possible without cryptocurrency. That's kind of like a main use case of cryptocurrency is the ransomware. And I think now with the Russian oligarchs evading sanctions through Bitcoin and all this, that is going to also just put it again top of mind. So that's my thoughts on that.
And what was your reaction? I pointed out, clearly, my personal opinion, of course, not investment advice, but crypto, Bitcoin is proving that it's a speculative asset. It's not a store of value. Stores of value don't go down in times of distress. I guess for a couple days, maybe it did appear like a store of value because it was holding up pretty well relative to the Russian ruble. But the thing I observe or I wonder about, when you have a momentum investment where all they really care about is number go up, it's not a store of value. The longer number not go up, the less interesting it becomes. And we have some chartists in the room, and I'd like Tommy Thornton to weigh in on his technical assessment of Bitcoin, if he can pull that up. But
because there's no intrinsic value of Bitcoin. It could be 1 cent or 100,000. Yeah, but the thing is,
exactly. So to me, and so what I want to ask you, Mt.Gox'ed, is because I know you do battle with a lot of the maxis and everything, and the last few weeks, like I think you've DM'd me and stuff and said they're starting to lose it and everything. And do you think we're on the verge of possibly, because you and I have called this before, possibly the dam finally breaking on this?
Unfortunately, I wouldn't make any predictions either way on crypto anymore. I've stopped doing that. Just how the fraudulent nature, it just makes it too unpredictable. Like they can literally set the price wherever they want, and that's the issue I'm seeing. I thought for a long time that it was going, to crash for various reasons, but now I just don't know anymore.
Well, I find it's a useful test run here. Bitcoin's had a chance to prove its metal as a store of value, and it's failed miserably. So can scratch that one.
The thing is, because it has no underlying value, there's no way to value it. So the exchanges, they can just buy the coins themselves, and they don't have to pay for them, and then they arbitrage the difference on other exchanges. So the real value is who knows? It's totally unregulated.
So last thing before we go any further, because I want to open up to questions, and again, I don't want this to become all about crypto. But Mt.Gox'ed, just to kind of humor people, for those who aren't as much in the weeds on crypto, could you just share maybe one or two the most outrageous crypto stories that's gone on recently that maybe the average person is not aware of?
Yeah, so you have the FTX's general counsel Daniel Friedberg and Tether's general counsel Stuart Hoegner, they were actually the attorneys that were representing those a poker scandal back in the day, like the biggest poker scandal of all time, where there was like a super user that could see everyone's cards, and they were the two attorneys, who were representing the site and defending them from these fraud allegations. And essentially, what's happening today is the same thing. You go on a crypto exchange, you go long or short, they can see your position and they trade against you. So these guys are known for literally defending known cheaters. And now they're doing it. It's the same thing. Like they can see your cards and they can see your position and they trade against you. So that's one thing. And the other thing is just the thing I realized over time is that every top in crypto ever has been due to a Ponzi scheme that was built on top of crypto, which was then buying Bitcoin 24/7 until it collapsed on itself, and that was built to the top. So you can just ask me the year, and I'll tell which Ponzi scheme it was. Since 2012, let's just for the whole existence, like it's all a fugazi. That's the thing. It's really all entirely hot air.
Right.
And I don't hear any maxis talk about that aspect.
Yeah. All right, that's great, Mt.Gox'ed. All right, so stay up there. Going to be a lot of questions, I'm sure. Let's now get everyone involved here. Raise your hand if you want to speak. I see we've got a waiting list of people to get on stage, so we're going to keep it tight. So my good friend Marcellus, followed by Three Aces, followed by Oligarch. Marcellus, what's up?
Yeah, I just have a question for Mt.Gox'ed. I'm curious of the European angle and what the outlook is. Is there any acceptance or potential understanding that Europe's reliance on Russian oil and gas has largely funded this foray into Ukraine and his ability to rebuild his military to be able to do pull something like this off. I'm just curious if there's any acceptance
they're
of that.
talking about not relying on oil at all and jumping over to renewable energy instantly, but that's just brain dead. Like you can't just cut off oil and go over to green energy like in one hop. Just skip it all, stop funding his war. Like people are starting to realize that it's been funding his war and is funding his war, but there's nothing they can do about it.
No, I agree. In the short term, they're stuck. I'm hoping that there's an understanding that the policy decisions over the last 10 to 15 years have largely brought us to
I
this
don't think
point.
we hit that realization yet, but
Yeah.
I think it's coming. I think it's coming soon.
So actually, the most encouraging thing I saw it overnight, and I hate this motherfucker, but Elon Musk talking about, we got Marcellus, I don't know if you bribed Musk to say it, but Elon Musk talking about the need to produce more oil now. I mean, maybe the brain dead political class, they won't listen to common sense, they won't listen to Canadian oil mafia, but if Elon Musk does it, it must be true. So,
but it's also in his own self-interest because his net worth is plummeting. So he needs it actually to go back up.
Of course.
But it doesn't. It's comical.
But I don't know. You can't make this stuff up. Thanks for that, Marcellus.
Can I have a quick question from Mt.Gox'ed? So how does the rising oil prices lower his net worth?
No, it's just taking the whole market down. Like his entire net worth is in Tesla stock. Like that's what I meant.
Yeah, that makes sense. All right, Three Aces and then Oil Guy. What's up, Three Aces?
Good morning. Hey, Mt.Gox'ed. How are you, my brother? Just on the Bitcoin thing, just before we move on, I just wanted to make a couple of quick points that seem to shut down all of the crypto wackos with the 500,000 followers and all that stuff. So, the question, for the Bitcoin crew, notwithstanding the fraud, Mt.Gox'ed, is, it doesn't matter what price, rice, sugar, corn, wheat, copper, oil, gas, doesn't matter what price they are. They're all used for the same thing, right? And they have infinite number of uses, right? So Bitcoin is the same thing. It doesn't matter what price it is. It can be, the utility value of it is the same, right? So the price of Bitcoin doesn't change what it can be used for. Just like in California, electricity is 41 cents a kilowatt, and in Georgia it's 6. It does the same thing, and it has infinite number of uses, right? So every time, I present that to them, that's when I get 15 of them throwing tomatoes at me. The second thing is that, this guy tells me I'm having a Bitcoin payment only poker tournament in Las Vegas, right? And you can only pay with Bitcoin. So I says to him, so if I buy in with Bitcoin, right, I've got to pay capital gains on my Bitcoin gain, right, just for the privilege of paying to get into the tournament versus using my American Express card or a wire transfer. I said, who on earth would do that? Who on earth would pay a 40 some odd percent tax, okay, just for the privilege of making a payment with something, right? And of course, they can't answer that one either. And then the third one is, George, I've been overseas for the last decade and been doing business overseas for a decade before that. So, the tax laws in the United States are very simple. A brokerage firm does not have to. Well, when you have an account in an Isle of Man or a Mauritius or a Caymans or a Antigua, I should say, or one of these places, right? There's no reporting. There's no reporting to the IRS, right? You have to self-report, right? It's called FACTA. These laws have been in place for decades. There's the same laws that put Manafort in jail, right? You have to report all of your bank accounts, anything that you have physical signing authority over that have assets in there. You have to report them. They may not be taxable because, if you own a deli in, Belize, right, the operating income from that deli is not taxable in the United States, but passive income is. If you're in Belize and you're buying and selling Intel or Tesla or Bitcoin, you have to report those gains or losses, and you have to you have to pay taxes on them, right? So these guys are all running around, oh, is Coinbase going to give the IRS? The IRS doesn't need that to prosecute, right? It's your obligation. It's the taxpayer's obligation to report those things. So all of these guys running around for years and years and years now and everything else, they're in for a pretty big surprise. So I just wanted to throw my 2 cents there on Bitcoin.
Thanks for that. Three. So before you stop talking, I want to ask you a question. Since you've been doing business abroad for decades, and you got a lot of so not just your experience, but also materials and everything. You and I were talking, I think, earlier today. The way supply chains are set up, if you don't get this widget or that part or whatever, the whole thing falls apart. So I'm just kind of wondering, not that you know anything specifically, but as you read the papers as I do, and you hear about, supply of rebar steel is going to get cut, and the supply of I forget what crazy chemical it was, neon, I think it was, coming out of Ukraine, whatever. Like, I don't see how we don't have a complete economic implosion. Oh, by the way, wait, there's more. I tweeted out, I'm sure you saw it, Three Aces. There were more articles about because none of the COVID vaccines in China really work. The COVID situation is starting to get worse now. We're going to see a resurgence in supply chain woes coming out of China, having nothing to do with Russia. So I'm asking you, Three Aces. I guess the question is, as you see all these supply chains getting screwed up, I don't want to even use the word supply chain because that's going to be conflated with the COVID thing, but just shortages of as Mt.Gox'ed was talking, together the Ukraine and the Russia, I think, account for like 26% of world wheat exports. So you see the wheat exports going away, you see the natural gas, you see the oil. Just go down the list. Like Three Aces, like, not to ask a leading question, but how does this not cause a hugely negative economic outturn?
Well, George, where we started to talk on the phone earlier before this, I was in the metals business for the batteries, right? The battery metal industry for a decade in Africa. And people would say to me, well, what industry are you in? And, copper, cobalt, nickel, zinc, this and that. I said, no, I'm in the roads, power, water, dams, electricity, spare parts business. I says, the copper's sitting there. We know it's sitting there. We've done the reserve analysis. We know where it is. It's right in front of us. Forget that. That's a foregone conclusion. If I lose any one of those things, I've got nothing, right? You can, when you're in National Geographic Africa, which is where that stuff is, and I mean National Geographic Africa, in the middle of no place, those resources are extremely valuable. And if you lose any one of them, you've got nothing. And that's what we have now. I mean, the Communist Manifesto, George, I mean, there's really only one true democracy in the world. It's the United States of America, right? Even in Canada, where they drill for oil and gas, and you've got all of these, charlatan geologists running around with these mining licenses for gold and stuff. Those minerals are owned by the government, right? Right in Africa, right? Because there were 52 of the 54 countries were colonized by 7 European countries, which are all socialist, communist-ish regimes. Basically, a foreign direct investor comes in, does a deal with the government in Congo or Zambia or one of these places, and you move the people off of the land that they've lived on since before the beginning of time, their ancestors. Excuse me, please move off to the side, put a fence around it, dig the stuff out, move it out of there, drive by kids that are dying of diseases that cost $3 to treat. And 4 guys in the central in the city, the politicians put all the money in their pocket. In America, if your grandpapa, staked a 100,000-acre, ranch in North Dakota, and you've got Bakken Shale there, ExxonMobil that sends a land ban out and rolls up on your property, writes you $100 million check, and you get a 20% royalty for the rest of your life. That's the difference. America's the only country in the world that's like that. Okay. And the Chinese, right, with Davos, right, and Fink and ESG and this whole regime, okay, are trying to take out democracy. That's the war that we're fighting now. And the United States is the only country in the world that has a true democracy, right? So if you look at the ESG farce, just another fraud, right? Just like climate change, just like COVID, these are all crimes against humanity. If you look at the core of it, what's happening here is very, very simple, George. First of all, the social governance aspect of ESG is a completely disregarded entity, right? This is an attack on hydrocarbons. Why? Because China doesn't have any. What does China have? I know personally, for the last 15 years, China has had a suction cup with long-term exclusive offtake agreements sitting over the top of every single country in the world for metals, right? So China basically owns nearly 100%, not of the supply chain, of the natural resource chain as it relates to metals. So all ESG is doing is turning the energy market as it was, previously known, to be the hydrocarbon market, right? They're transitioning that to the metals market with the EV strategy, right? That's all that's happening here. Why? Because China owns 100% of the resource chain. Just like you're watching now with wheat in Russia, just like you're watching with Ukraine. What you're seeing here now, right, in terms of severity, is essentially a pimple on a fly's rear end, okay? Because every single major automotive company in the world is now allocating hundreds of billions of dollars in aggregate combined towards towards the EV stuff, right? Well, who owns all the cards? You think we got a problem now with oil, with Russia's oil exports and that gas? What happens when the communist regime, who's behind all of this stuff, COVID, all of it, right? They have all the cards, George. And Fink and BlackRock and ESG and all of this stuff is designed to give them the power. They have the power.
All right.
So that's what you got. Sorry,
Yep.
George.
All right. No, that's great. That's great. All right. So, because you have passion like me, it's one of the things I love about it. All right. So, we're going to do Mt. Gox. You have a follow-up question or comment, and then, oh, God. Mt.
I just
Gox?
have my final comment on crypto. It's
Go
an
ahead.
important one. It's an important one. So back in the day, Mt.Gox'ed was the biggest exchange. 70% of all volume was on there. And the whole run-up to $1,000 was fake. So for 2 years, there were 2 bots buying without paying for coins. They collected 850,000 Bitcoin. They bought them 10 to 19 Bitcoin at randomized time intervals. So they collected 850,000 Bitcoin from people, which pumped the price, because the difference was arbitraged out on the other small exchanges. So the whole run-up, the first run-up, was completely fraudulent. And, it went bankrupt in the end because, they didn't have any real money. There wasn't any money there. But that's why the whole foundation is rotten in crypto. Like, it's all fucking hot air. The whole first run-up was hot air. That's one thing I want to say.
Thanks, Mt. Gox. Okay. So we're going to do Oil God, Bobby J, and then my friend John Shaw. Well, God, what's up? Good to see you, my friend.
Yeah, good morning. And Sohaib, good morning. Deep, good morning. Long time no see to all of my friends. George, a few comments I want to say. I think Three Aces is bang on. This is exactly what we've been talking about for weeks now. And with respect to how we've played this, I'm short Tesla. And so I'm sure it's Shopify as well. And so when we got the article yesterday or the tweet from Elon Musk, I can tell you I've never had a tweet give me an erection before in my entire life. But that was just, I'm so excited for the markets to open on Monday because I
Wait,
think
oh God, was this? Maybe this is TMI. I don't know, but you got little. Was that so? What's this? Right? Was what's the old line when you see a woman comes up to you in a bar and something? Was that a cell phone you're vibrating in your pocket? You just happy to see me, so you got a little bit excited for Elon Musk tweet. Is
very
that what you were saying?
excited. I say, George, very excited. But let me just continue on with the crypto thing because this is going to be, if you look back, so the Canadian Oil Mafia did a fantastic job of kind of connecting all the dots as to what's happening in the real world. We look at data, right? Supply, tankers, you name it, right? We pull in all of our resources. And George, we really appreciated you being on our 14-hour marathon session yesterday. I saw you there throughout the day, and I really appreciated it. And I know Sohaib and Deep did as well. But let me go back and talk about crypto. This is actually going to be an inflection point, and this is going to be a divide down basically the planet Earth because everybody is right. China's sitting back. The US is not provoking China. There is no State of the Union, even discussion on China for the first time in 5 years. Three Aces is absolutely right. They've supplied oil from Iran, probably now Russia. They've obviously pillaged Africa for all of their for all of the metals, and so they control the supply chain. COVID, be COVID, it doesn't matter because at the end of the day, the effects of COVID are largely, I'm going to say, dissipating, right? People are already on the move. They're starting to defy authority. They're getting tired. They're convoys, you name it. Doesn't matter the country. People are hitting the streets. So what Bitcoin is going to allow is the nations that we've all prognosticated working together. This is why you're seeing the Indian communities, largely OPEC, the Middle East, very, very quiet during a time like this. OPEC's meeting was 13 minutes. Okay. Again, you'd think at a time where, they could really go out and help the United States, they could really look at the Western democracies. You wanted some level of indication of how much of a shit they gave about your economy. They don't. This is all about money and control. And what Bitcoin is now going to allow, potentially, if we buy this argument, is a way for all of them to circumvent all US influence and say, you know what, we understand you don't prefer us to work together, but it actually may be in our own, at best, economic interest to continue to do so. And I think this is why it's making the world very, very tricky right now. The US is a consuming nation. They consume the things that the Asians produce. And what Three Aces is saying is why I do genuinely think we are long commodities, short tech. And we've talked about this many, many times. We don't have to get down the weeds here. But look at Rivian. I talked about this on Monday. We had so many material events with Elon Musk yesterday promoting oil, which is just insane to me. But go look at Monday when you actually had an EV maker attempt to raise prices and then had to backpedal within 2 business days. Literally backpedal, right? We're going to make cars. We have no idea what the fuck the costs are going to be. But hey, all of a sudden our costs are up 50% and we're going to charge you more. Oh, wait, you don't like that? Oh, okay, well, we won't do it. Thank you so much for letting us know. And then the stock is down another $18, right?
Yeah. So, Olga, let me interrupt you. So, all the anecdotes all to me come to one place, which is, and this sort of just piles on, pours gasoline on the fire, no pun intended, of the trend we've been going in for months and months and months, which is, away from long duration, highly valued assets to short duration, lowly valued assets, movement away from the virtual to the real. And I think, you said something which really tickled my fancy. Might this conflict actually be sort of the defining moment as to when crypto finally gets flushed down the toilet? In other words, is this the beginning of the end? I'm not saying it is. I haven't thought it out, but it kind of feels to me just like it was the pandemic, which kind of really, made it go vertical and explode completely. And we know all the reasons why. As in, run the movie in reverse, and as you rightly point out, sort of geopolitical angle to this whole thing, as Mt.Gox was referencing, it was only in the spring of 2021, and Michael Green spoke eloquently to this point, when we had the Colonial Pipeline event, and I don't want to go too much into the weeds if we can, if people have questions. It's when the authorities first really woke up.
Yeah, so
And
George,
now they're being given a
let me
real reminder smacked over the head. So I don't know. I'm just wondering if we're going to look back on this, and we're going to say that was it. That was the death knell for crypto. I
well,
don't
this
know.
is the
Thoughts?
inflection point, George, and I'll pass it
Yes.
to the next speaker. But what I'm gonna say,
Yep.
it makes absolute sense for Western nations, especially the United States, to ban crypto. I don't think it's without saying. I mean, if you listen to the Fed, even Jay Powell talked about it. You listen to the Department of Justice. All they use is words like money laundering, evasion, etc., etc. And we all know that cash, is exceedingly untraceable. And if you, especially in a place like Vancouver real estate, which is, I just dabbled in. Heaven, God help me. God help me. I have to help myself, apparently. So what that means is all of the industry here, all of these trades, you've seen dirty money from lots of these nations come in. They pay to have homes rebuilt, largely with cash, right? You can buy all of the labor of a home, which is half the cost, in cash, right? And then what you end up doing is you clean your cash when somebody gives you a tax-free transaction once the home is complete, and you flip it. And
Right.
this is why this is a flippers economy. And so to
Yep.
stop home in all of these elevated prices, it makes absolute sense for these things to be shut down.
Yeah, completely.
But if
All
you're
right, okay.
Russia, but if you're
Oregon, just hold. Yeah, just hold it.
voice, you need
Point duly.
to.
Yep, we got it. All right. So just hold it, because I suspect we're going to talk a lot about crypto in this room. Just hold it. All right. So we're going to do Bobby J, follow up from Marcellus, and then Bobby J, John Shaw, and then follow up from Marcellus. Bobby J, good morning. How are you?
Good morning. I want to talk a little bit about the European banks, because the alarms are going off, and they're going off loud. Since the beginning of February, names like SocGen, Intesa, ING, Paribas, and even the insurance companies, George, like Allianz and AXA, are down anywhere from 20 to 40%. And you've asked me to keep an eye on credit. We have not seen this distress show up in credit spreads, double B spreads, but they are definitely showing up in the European bank stocks. And there's a couple comments I'd like to make about this. First, I'd like to attack the myths and the bad reporting that has been surrounding this. And, there's been some fallacies being thrown out there, like, Russia's GDP is only 1.4 trillion, whatever it is, the size of Texas. Exposure is not that great. False. Second, that the banks themselves don't have direct exposure to Russia that's in any way meaningful, more than 2, 3, 4% of total assets, and ING and a couple of other names have the most. So you don't have to worry. False. And the reason that is because of the credit grid in Europe and the impact the other countries are going to have in terms of non-performing loans from this entire economic slowdown. And the other thing we were hearing is by banks, rates are going up. False. And then I heard Karen Feinerman on CNBC, and I can only take small doses of CNBC, saying, I don't understand it. The consumer's in good shape. The unemployment is low. Why would there be a problem with consumer credit? And she's right. She doesn't understand it. We saw the credit card banks in the U.S. down approximately 20% over the last several weeks. But let's get back to Europe, because this is about Europe. The one thing I want to highlight is about Italy. Italy was the poster child for non-performing loans from the European crisis. It took 4 years after 2011 for the Italian non-performers to peak in 2015 at 341 billion. Right. So for people who want to pick a bottom and say, well, is this over? Can I jump back in? You're not going to be seeing a peak in non-performing loans from this whole situation for possibly 2 years. I've been thinking about how to label this. I used to call Italy sushi marinara because it had Japanese growth issues, actually far worse than Japan, but nobody talked about it. But I think we're going to see a another surge in non-performing loans in Italy. I mean, there was already some stresses that were showing up from COVID prior to the Russian situation, but it took Italy 6 years to reduce their non-performing loans from 341 billion down to 99 billion, and they still aren't out of the woods because I think they're at the 4 or 5% level of non-performers. So picture this. I mean, they had a major accident. They're in a body cast. They're in the hospital. They finally go through therapy. They go home and they get out of the car and they get hit by another car. So I just think Europe, we're only in the second or third inning of the credit situation in Europe.
So Bobby J, I'm so grateful for your insights. And again, I'm going to plug this room. There's no commercial gain for anybody here. It's just a bunch of guys putting on one shoe at a time, trying to figure this out, helping each other. The type of insights we get in this room from people like Bobby J. I mean, you and I have been talking. You and I have been talking for like a year. It's like credit's boring. Credit's boring. You said, you referenced it again. It was your homework assignment to speak up when the smoke alarm starts to flash, and you're doing it. And it's funny. I do this not to listen to myself talk or have fun, although I do have fun. I learned so much from you guys, and I really thank you for that, Bobby J. It's just amazing
Well,
the people in this room.
some people have accused me of thinking about the yield curve and credit spreads every 7 seconds.
Thanks. All right, so Bobby, stay up there. All right, so we're going to go to John Shaw and then Marcellus, and then I'd like Tommy Thornton, if he's listening, to weigh in on what he's seeing in markets and maybe crypto. So John, good to see you. What's going on, John?
How's it going, George? Thanks for having me. So great stuff. I knew I had to come on stage the second I saw the name Mt.Gox'ed, man. I was actually back on the hill in 2013, and I remember Mt.Gox'ed. I started tracking Bitcoin. It was a little under 100, I think. I think I actually wrote one of the first white papers on it from a regulatory perspective and the potential it had to impact on the dollar. And I swear, hand over heart, not a single human being wanted it. Like, no one cared, no one knew, no one gave two shits. So couple of quick notes on crypto that I'm seeing right now. I'm actually viewing it more as and you're right about who would actually do this stuff with the pay the capital gains tax. If you're thinking about it from an economic framework, the truth is though, it's more social signaling. Like NFTs, like people now are requiring NFTs to go to parties in Manhattan. Basically, it's a way to signal stupid levels of wealth via conspicuous consumption, right? And of course, we can all talk about the money laundering. I think it was Oil God who talked about this. We all know that's true. There's a reason why the largest crypto exchange in the world is based in Malta. Come on. I mean, what are they talking about here? There's a reason why the head of Coinbase, Kraken, etc. They're all saying, no, we don't need to cut off Russia from the exchanges. The ledger is publicly accessible. I mean, are we joking? There's a reason why all these miners are coming out of Russia, China, North Korea. Yeah, okay, yeah, it gets them some foreign currency, but who has more to lose by the adoption of a cryptocurrency around the world? I mean, this is some really basic stuff, but when we're thinking about why people are using it, it's more social economic than I think pure economic. So that's a couple of really quick throwdowns on crypto. I could talk Ukraine, the wheat stuff all day. I've been tracking those numbers for a while. I'm interested in the second and third order effects at this point, George. Not like what country's going to get blown up because of the wheat imports. That's easy. It's what do those countries produce? What do those countries produce where social instability might happen? Are we going to see maybe potential impacts out of the port of Durban, right? That in South Africa? Are we going to see potential impacts coming out of Libya with another oil shortage because they now have two competing governments, and now you have food prices spiking. Everyone's now rattling off the Arab Spring comment. We all know this stuff, but again, it's looking at the downstream effects that really matter. Your thing about Peter Zion, man, like I chuckled hard at that. I was actually an intern at Stratfor back in undergrad, so I can talk that stuff along with like Marco Papich and George Friedman, those guys, like
All right.
they're
Well,
smart.
so John, there's a lot to unpack there. Let's start with has the die been cast? Do you think in terms, or how far are we away from the situation where we're going to get these, second order effects? I mean, I talked about at the top about all these different commodities, whatever, and just when you mess up a system, it just a thing implodes. And so, like, are we beyond the past point of no return, or how far are we away from that in terms of seeing some big dislocations economically or from a socioeconomic perspective because of what's happening?
Well, right now, understand what a lot of these countries are doing is what we're really talking about is the stress on the public accounts. Because a lot of the major wheat importing countries, they subsidize it, and they subsidize it heavily. And I forget again who's talking about it. It might have been Three Aces. We're seeing this in Europe, or maybe it was Mt.Gox'ed. We're seeing it in Europe where the playbook is simple. You subsidize on the fuel side, right? I mean, some of these is really easy to understand. Like France saw this in 2018 with the yellow vests. And Macron, they've got an election coming up in April. It's not a chance in hell he was going to allow anything basically to try and mess up his chance to get reelected, right? So, we're seeing out of Europe the subsidy playbook, both on the electricity and the fuel side. It's being expanded rapidly because of the price of oil doing what it's doing. On the wheat side, it's a little trickier because the countries that tend to subsidize wheat don't tend to have the strongest public accounts anyway. So when we're looking at where wheat imports are largest, you're talking about countries like Egypt, Turkey, China, Algeria, Bangladesh, Iran, ironically Brazil, then you have to look at substitutions. Can you get an effective substitution? Well, look at what corn is doing right now. Look at what soy is doing right now. Everything is up. So the substitution method isn't as easy to understand. So now we're looking at, okay, well, what's the core of their food? Is it made with wheat? Is it made with soy? Is it made with like seed oil, which is very popular in Central Asian nations? So you're the quote unquote the stands, right? Everything from Turkmenistan to Tajikistan. It's sort of understanding of the core inputs here. I'm not sure if the rubber has hit the road yet, but I don't think we're far off away. I think it's kind of getting baked in, and it's more of a nexus, right? You're looking at like
yeah. Because let me just interject because there was like some people out there saying, hey, the growing season's not far off. If this stuff doesn't stop, like we're going to be past the point of no return, blah blah blah. So I guess what I'm asking you is, I mean, yeah, you outlined very clearly the risks, but I think in terms of what rubber hitting the road and how it's going to affect markets, I mean, is it soup yet?
Panic buying, man.
We still got? Sorry.
I think right now you're going to see panic buying into sectors people are not very familiar with. I think we're already starting to see it. My God, dude, I swore hand over heart that I would never look at Argentina till the day I died, and I'm looking at Argentine equities, man. Like you have to kind of go where the goods are. I mean, it might very well be a really positive impact on stuff in South America. You have to really start considering companies that have a history of screw ups and but at the same time have access to a lot of the metals. I mean, companies like Vale. I don't want to drop too many names, but there's places out there that you can go and get stuff. It's an odd place, but that's the world we're living in, man.
Yeah, no, it's good stuff. Thanks for that, Sean. Appreciate it. All right, let's move on. Mr. Thornton, if you're there and you want to give us just a couple of your ruminations from the past week, talk about whatever you want. Particularly though, in your machinations, if you could just also say a word on Bitcoin, cover Bitcoin, because I think that looks pretty dangerous. But go ahead, Tommy. What's up, man?
Okay, I might get interrupted because my wife's trying to bug me. I'm at my office and she wants to go to lunch. But wow, what a crazy week! And George, I have to say, every time I listen to your spaces, all these contributors are just fascinating and have been incredibly enlightening. I'm learning something every single time I come, and I'm sure everybody's the same way. It's just been fantastic. And some of the stories, I mean, the Bitcoin stories are pretty amazing. I didn't know that it was all bots taking it up to 1,000. I thought it was, well, I guess that's why everything blew up. But it's going to be interesting to see what happens with Bitcoin. A couple things, my overall view, I'll go over a couple things on markets, and I want to talk about market sentiment because I track market sentiment pretty closely. First of all, nothing's really changed in my view of what I've been expecting. I've been saying that we would have lower highs, and that's been happening. I do believe that in the U.S., the recent lows will be taken out to the downside. Those are based on, the fact that I look at DeMark indicators, and we have had downside DeMark sequential countdowns in progress. We also have a little younger DeMark countdowns in Europe. That means it goes up to 13. It's in the 2 or 3, 4 range on depending on what index you're looking at. That's a little bit more concerning, especially the steepness. I always like to say, if you're a technician and think of it, the steepness like you're a plane and you're dive bombing and you start to pull up on the stick, you're going to go down a little further before you stabilize. So I think that's where we are right now. So that's really concerning to me. We've held the lows in the U.S. for now. I'm not sure if they're going to hold. I will be honest. I did cover a bunch of stuff late on Friday, and I went long. Everybody can just, we'll see where that goes. But I've had enough gains this year to be able to take a little bit of risk, hoping for, let's say, just less bad news, and maybe we'll get a bit of a bounce. So sentiment, market sentiment. I'm looking at all my sentiment indicators right now, and the S&P is at 22% bulls. It's been lower. It went to 10 recently. It's down 6 on Friday, and the Nasdaq's at 27, down 6%. And basically, this is the daily sentiment index I get from Jake Bernstein, and I have created some nice charts that you can look at the historical, patterns. Bonds are ripping on bullish sentiment. The 10-year is at 46%, up 9, and the 30-year, which I look at the 30-year sentiment more than the 10-year, it's at 53, up 12. These were in the, I think around, they did hit 10% recently as well. So when they get over the 50% level, that creates a majority of people that are now more bullish on bonds, and there's a big positioning issue with bonds that could cause a bit of a squeeze. Now, currencies, Bitcoin's at 31, down 8. Bitcoin has not been able to get above 50%, that majority line, for quite a while, and it did get into the single digits briefly. The dollar's been the big theme. Long the dollar, it's at 89%, up 6. That's when it's above 80%. I consider that the extreme zone, and it's been bullish above those levels, and it's held that level. Actually, it's been around 60% on the recent lows over the last 6 months, and it's held that level, I think, 5 times. The euro is at 5% bulls, down 4. So you don't have a lot of people that are bullish on the euro. And usually when I see readings at 95% or 5%, I'll start to say it's not going to last at these levels, and you could see a bit of a turn. So that's something I'm watching right now pretty closely. I can go through all the other currencies, but more importantly, right now, I've never seen commodity bullish sentiment on the whole as high as I've ever seen. And of course, we're seeing, this is the largest inflationary spike we've ever had in our careers. And we have this situation in Ukraine causing all sorts of problems. But crude sentiment is at 96%. It's up 6 points on Friday. And I went back through my history, and I've only seen crude above 96, I think 4 times in the last 20 years, and it gets up to 97%. So we're really, struggling here to find, more bulls here, and that's a concern. Now, nat gas is at 90, gold is at 86, silver is 86, platinum 75, palladium 91, copper 85, corn 88, wheat 96. These are very, very extreme levels. And the one thing I like to tell people, and a lot of people will look at different sentiment polls and they say, oh, it's, the AAII is the most bearish ever or the most bullish ever. Those polls don't really matter to me. Sentiment is a condition. It is not a trigger. So sentiment can and will stay bullish for a lot longer. From 2007 through 2008, crude sentiment stayed above that 80% level for most of that period, and we went to 100. I think it was almost 150 per barrel, and then when it finally cracked, it went down to single digits. So it's
Right.
it's possible.
Yes, Tommy, that's brilliant. Let me just throw a couple questions at you. So I want to pick up on the last point you made. Sentiment being a condition, not a trigger.
Mm-hmm.
And this gets to, in a bull market, you only can be long or flat. And in a bear market, short or flat. Fools there to try to trade counter trend. Okay. But what if we speak to multiple time frames? In other words, perhaps it's the case that in the short run, you're right, this thing could sell off. But as our Maxi friends would say, zoom out. How would you respond to the notion that, this is the initial thrust lift off? I mean, you got some of these technical models that try to, I can't remember who the guy was running around with this thrust model a few years ago. I think it was Mel Seedon or somebody. In that the initial thrust, rather than frowning on this and say, oh, it's overbought, the idiots in the CNBC are touting it, blah, blah, blah. No. I mean, there was a guy at Fidelity. I'm ranting now. Leo Dworsky, he passed away a couple of years ago. He was a true contrarian investor. And he really was a contrarian. And people, again, this sort of superficial newbie investor class, I have Google, I'm going to be a contrarian. No. They don't really understand what being a contrarian is. Let me give you an example. If you were prescient enough to have bought the heck out of tech stocks going back to the OOs, say you're Bill Miller or whatever, and you bought all these tech stocks and you rode it and whatever. You could have at any time along the way, like take Amazon as an example, right? Amazon, as you and I got this conversation, Tommy. Amazon went from 110 to 6 before it went to 3,500. I kind of suspect that I know I would have gotten shaken out if I was lucky enough to have owned it at 110. I don't know too many people would have stayed in for the ride. But the point I want to make is someone could have said, oh, look at Amazon. It's going up. It's gone from 6 up to 100, up to 200. Oh, it's overbought. Look at the sentiment. But the real contrary observation that Leo would make if he were alive would have been to have said, no. The real contrarian opinion now is to be uber bullish on Amazon because people don't really understand what they own. You have this sort of lazy, complacent, go with the mo. Nobody knows what they own. And so the real contrarian thing is, no, it's going to go up a lot more than people imagine. And I see Marcellus is clapping because I personally happen to believe that's where energy is right now, Marcellus. That's the question you're going to ask. So I did your work for you, all right? So this idea that, oh, everything is like people are too bullish right now. Yeah, okay, fine. So, Biden comes on his hands and knees, comes begging for a JCPOA agreement. He gets one, even though it's taken longer than we expected. There's headline risk. We all know that fundamentally, for anyone who's been in the oil mafia rooms, doesn't mean anything. Doesn't matter a hill of beans, as Humphrey Bogart would say in Casablanca. But, and so, okay, great. So oil sells off $10. Oh, it crashes to levels not seen since last Tuesday. All right? Like, the reason Marcellus and Oil God and Sohaib and all my Shabam, all my Canadian fellow Canadian oil mafiosos, mafiosos. I don't know if that's singular or plural. Mafiosos own the stuff. It's got nothing to do with the spot price of oil. So I would challenge you to challenge in a friendly way, Tommy. I'm slapping you around, saying, could it not be a multiple time frame thing? Yes, it's overbought. Yes, the tourists who got in, in at the top, My Life in Times by Jim Cramer, as told to Kayla Tausche, okay? Like, he'll panic for the hills, all right? But the real believers, okay, they're the contrarians, okay? And the fact that oil's gone from 2% of the S&P to 3% of the S&P, having been at 23% of the S&P, and I'm not shilling for oil stocks. I'm just saying what I'm really getting frustrated about, not at you, but all these assholes in FinTwit. Oh, I'm a contrarian. They don't know shit about what a real contrarian is. So I don't know what part of that you want to respond to or whatever, but I guess the question really is, how would you respond to the notion that really all we've seen is this is just maybe the first or second inning in a major league structural bull market for commodities and oil, in the same way, and you couldn't be able to ride this for years, in the same way that you could have made the case for tech if you were as smart as Bill Miller was, and that, yeah, okay, it sells off, but who cares? It's going much, much higher. Floor is yours, Tommy.
Okay, well, I actually am in agreement with you. I think that we can stay at a place where these stay in that overbought zone for a while, just like we saw in, I was really just 2006 through 2008, I think, when it started to really break apart. But okay, so for example, I've told all my people, yeah, we have some short-term DeMark exhaustion signals, but you're going to get those run over if the Ukraine situation gets out of hand. And when I see trends like this and the short-term DeMark signals on dailies just get, they don't work, which tells you something actually very, very important, saying that this trend is very, very strong. And then there's a lot of people that will look just for some of these signals to fail to determine that strength. So I zoom out and I look at the weekly charts and I look at the monthly charts. And let me say the weekly first. The weekly is on week 10 of 13. And so there's still more upside there. If you look at the monthly chart, it's on month 5 of 13. So we could be, and so like I'll zoom out and say, okay, this trend is exceptionally strong. It can and will stay very, very strong for a long time. And, my view, and I've been reading and watching a lot of different interviews with people and, strategists and global macro strategists about the commodity shortages that are coming, food shortages, the implications with what's going to happen with Russian oil being cut off and gas being cut off. It's going to last a long time, a lot longer. And the only thing that will prevent this from lasting a lot longer is if the Ukraine situation ended this week. And I don't see that happening. I don't think anybody sees that happening. So we're in this for the long haul. It's, yeah, I'm in agreement. I think
Tommy,
we're
let
in
me
a
ask a
different
question.
realm.
Tommy, let me ask you this question another way. I think most fundamental investors would say the more you zoom out, the more conviction you'll have. Like if you ask me, what's my batting average on, 1 year views as opposed to 1 week views, it's like not even close, right? And so trying to call short-term jiggles is like a fool's errand. So I guess my question to you is, over time, because you've been doing this for a while, you have more confidence in your short-term indicators or your longer-term indicators?
I actually have more confidence in my shorter term indicators.
Okay.
And I can deal with little jiggles here and there, and that's how I make money. But in the longer term, yeah, I see the big picture, and I'm a trader, and I could see I could see crude dropping back down to 100, whatever. It doesn't really matter because it's probably just going to keep going up, and if that happens, it's an SPR release, and you know how good those work. So I agree with your energy call here.
Yeah, I mean, Tommy, let me put it the other way. You think about all those stocks for the long term. Jeremy Siegel call your office, and all the wealth management guys. Oh, I can't sell. You should never try to time the market. And if it goes down, if I sell, I got to pay taxes. And if it goes down, how do I get back in? And blah 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 blah. All right. If you spend any time, and so you look at energy, and I'm going to shill for Marcellus and Sohaib and Oil God and everybody else here. Okay, it's like, why should I try to freaking time the correction in oil? The bottom line is, if Eric Nuttall's right, and these things are in 2 times cash flow based on oil prices at 80, do I really care if oil goes down $10 the next week? Actually, you know what? I actually would prefer that would happen, because maybe Jim Cramer and his acolytes will panic and it'll give me a chance to buy more. So, like, in the same way, you want to stay in gear with trend. And Peter Lynch, please call your office. Know what you own.
Yeah, I'm looking for. Look, I'm George. I get it. I'm just looking for entry points, and
yeah, all right,
and
fine.
as you know, I was.
Tommy, yeah, please understand, this is all friendly between you and I. It's like we're talking the same way.
I don't take it serious.
Yeah. So, because that's really, because most of the people in this room, Tommy, they can't get the zigs and zags. They don't watch the thing 24/7 like you do. They're also not that interested in it, and so that's why I'm hounding you on this bigger picture call. So all right, so Tom, if you could hang around as long as your wife will allow you, that'd be fantastic. And always appreciate your inputs. And again, Tommy comes in here, he charges, zillions to institutional clients. I'm not shilling for him. I don't have any commercial relationship with him, but he's money, and he has a retail product as well, which is, you'll pay for it in 1 week. So if you're interested, please reach out to Tom. He's always looking for new clients. He didn't ask me to say this. I'm saying because he's a good guy. He deserves more customers. It's hedge fund telemetry. You'll find him on Twitter. He's also on the internet. Does great work. Can't recommend it enough. Thanks for that, Tommy. All
Thanks,
right.
George.
Yeah, now we're going to do, so Marcellus is the follow-up, Three Aces is the follow-up, and then we got Michael K is in the house, and then K-Fab. So Marcellus, what's up?
Wow, a lot has been covered here in the last 10 or 15 minutes. So
what did you expect? What did you expect, Marcellus? Go on.
I'll try to stay as concise as I can. I do want to point out, I did post something up in the nest. I don't know if you follow Doomberg or not, but I think for me,
love Doomberg, one of the smartest guys on Twitter. Go on.
Yeah, he's a must follow. He put out an article this morning that I think is really important for people to read and grasp. There are second and third order and longer term impacts potentially to the global financial markets that are coming out of this Russian-Ukrainian issue, and I think people need to make themselves at least aware of the potential of where things could go long term. And I am the last person to push crypto. I am not a crypto person. Never owned it. Don't ever really plan on owning it. However, I will say this: some of the reactions by Western governments over the last month, starting with, you could say Justin Trudeau, the sanctions, basically freezing all of Russia's foreign reserve. That's going to really have lasting impacts, I think, moving forward. And it puts the U.S. dollar, and I'm not saying this is happening. I'm just saying there are things happening that are going to raise eyebrows outside of the West. In growing places like China and India, you have 3 billion people there, and you can't argue that the growth in the world is going to be in Southeast Asia moving forward. What's happening in the reaction to this is raising eyebrows. And I think it behooves people to understand what the Western reaction, what these sanctions are potentially creating long term. Obviously, the Fed has their eyes on crypto, but the actions of the West could potentially actually increase or strengthen the argument for crypto. Again, I'm not a crypto guy. Don't own one piece of it. Never have. But the argument could be made that the seizure of assets by Western governments of Russian oligarchs. How do you define that? I mean, who's an oligarch? Where do they fall? Or the seizure of those assets without any sort of trial or any real definition. It creates danger, I think, in the global financial system, and maybe the trust that the world has had in the U.S. dollar being a default currency, reserve currency, and Western governments being able to be good stewards of the global financial systems. There may be some cracks in that foundation.
Totally agree. Great observation. All right, Three Aces, and then Michael K, and then Mt.Gox'ed. Three Aces, you have a follow-up, Three Aces?
Yeah, I just, two things, a question for Tommy and a statement for Deep. I'd be more concerned about what Trudeau is doing in Canada than I would be about what's happening to these Russian billionaires. Trudeau is making up laws and then ex post facto, retroactively, enforcing them. and prosecuting people and freezing assets and putting them in jail. That is communism. All right, what's happening in Russia, these oligarchs, that shit's been going on for decades. Frightening, frightening. In any event, Tommy, I come from this school, that CEOs lie and stock charts don't. So I've had a tendency to be heavily, emphasis on technicals, not having any of the skills you do. But when I look at the situation in wheat now, to where Ukraine is the fifth largest wheat producer in the world. There's not going to be a planting season. I think Russia is one of the top wheat producing countries in the world. We shit show there. This morning, Maersk and all the shippers shut off any kind of container pathways due to insurance, inability to get insurance to insure the goods. We look at fertilizer, the same, right? Forget about the fact that billions of people who don't even have power and water, okay, are relying on that stuff to be cheap in order to just feed themselves, nothing else. Forget about the atrocity with all that. Just talking about the stock charts here, and then 5 million barrels of Ural oil should be coming off the market here in the next number of weeks. At what point do you start paying attention to that stuff, or in terms of overbought kind of stuff and oversold, and just start getting sucked into that sort of the headline news? Do you ever do that, or is it just always purely 100% just technical stuff?
No,
In the form of a question. Yeah, sorry.
No, I get it. And I'll tell you, I agree with sometimes a CEO will lie to you. There's a guy named Cyril Yansuni who basically ran 3Com, and I had a conversation with him that basically I'd like to punch him in the face. But anyway, let him go. Let it go, Tom. Let it go. Yeah, when the thing is, yeah, I'm looking at wheat right now and on my chart, and it's just, pegged straight up every single day, limit up. And the problem is, just like anything, just like when ARC got up to these high levels and things get overbought, it creates almost a bubble, and the chances of something positive that would let up the price, let's just say, this Ukraine situation moderate, it there's a ceasefire or something positive happens, and I'm not there yet, but the chances of it dropping a lot harder, like a bubble popping, is there. So right now we're very we're overbought, but it can and will stay overbought. It's I heard Peter, what's his name, say it's going to quadruple. Yeah, it may, but I think that bottom line right now, all these things, you can't sell them. If you're long, stay long. It's hard to buy them at these levels. I probably, I'm not telling people to buy crude or any commodities at these levels. It's just my work with the sentiment at these levels.
All right. So Tommy, let me interrupt you. Because you just hit a tripwire for me. Like Peter Lynch used to say, Mr. Market doesn't know what your cost basis is. So let me put the question to you another way, okay? You're hired by a firm to trade a book. You come in. They're long all this, oil, wheat, whatever, stuff that's gone straight up. You have you get no credit for that P&L because you weren't the one to put the trade on. Mm-hmm. And like a CEO, to use your analogy, CEOs often they'll clean house and they can take a write-off and blame everything on the predecessor just to clear the decks. So you have all these legacy positions you've assumed that are in the money. You're not going to get paid any bonus on that. However, on the subsequent price appreciation or depreciation, that's going to accrue to your benefit or detriment. So you come in, you're the new commodities trader. These are the positions. We're marking your cost basis to today's opening mark. What do you do? Are you selling them or hanging on to them?
Why did I take this job? That's the question. Look, I just think that if you got a 50% chance they go up and and 50% they go down, and it's a 50-50. I would certainly say I'd have a plan of where I'd want to stop out. If my cost is at 1209 on wheat futures, this goes down, I'm going to stop myself out and then establish my own cost basis where I want to be in there. And that's simply how I would do it. And you're in a no-win situation, honestly, if you're inheriting a book. That's,
Yeah.
I mean, if anybody's ever inherited a book, which it happens, and if you have a CEO of a firm, a trading firm or a hedge fund that is bullish on all this stuff, and you have an ounce of contrarianism to their positions, you're not going to be long. And I can tell you that for a fact, because in 2011, in August, I basically sealed my fate at a trading firm because I said that gold was peaking and I would short GLD, and it worked really well, but I was without a job in December 1st because he just was pissed because I was right. So look,
Yeah.
it's impossible to inherit a book right here and say, what do you do? I can also recall I worked for another hedge fund for like the amount of time I drank a cup of coffee because he was nuts. He bought a bunch of Euro futures, European index futures on the day that, at the peak on that day that, what's his name, Draghi said anything, well, whatever it takes.
Yeah, whatever it takes, exactly. Yep.
And then he was on his way to the Hamptons, and he called me and he said, put in some realistic stops, and they were up like 3 or 4%. And I said, okay, I'm gonna put it in halfway, where it was that range of the previous day. And we got stopped out the next day. And basically he screamed and yelled at me, and I quit that day. And I said, come on. So it's hard to inherit a book and say, what do you do? I would establish my own positions.
Tommy, you gave a masterful answer to a very hard question. I was pushing your buttons. I wouldn't spring that question on a newbie, but you're a pro. Let me ask a variation on that question. And again, going back to Mr. Market doesn't know what your cost, doesn't hear what your cost basis is. Jack Nash, who was my first investor, my first hedge fund, he was ruthless about stuff, and he would say, and I wasn't capable of doing this. I don't think most people are. And he's a trader. He'd come in every day and he'd ask himself the question: would I buy or would I sell this right here, right now? Forget about whether you have an unrealized gain, unrealized loss. What would I do with this right now? All right. So I'll put the question to you another way. Let's say you come down from planet Mars. Okay, so you're going to this firm. Sohaib, who's right next to you, he was stuck with the position of having someone's book. Okay, you though, on the other hand, we're giving you a clean piece of paper, so you have no positions. So faced with, oh my God, the last thing I want to do is buy some crap and have it go straight down, versus, oh my God, maybe oil stocks are gonna be the gift that keeps on giving. Maybe the Canadian oil mafia is right. I don't have nothing on the sheets because I don't want to bet my life that it's going to go down. Maybe the pullback, there won't be a pullback, or maybe, you know what? The risk reward, i.e., I think there's a 50% chance it's going to go down 10%, and a 50% chance it won't go down, and more importantly, a year from now it's going to be up 100%. Maybe I'll just buy a little. So if you came in, again, you're not stuck with the book. Sohaib's stuck with the book. You got a clean sheet of paper. Would you be, to use a baseball analogy, because you're a Dodgers fan, right? You'd be taking a big lead off the bag, like wanting to buy this stuff. You'd be waiting until you get the correction first. You can stay close to the bag, or you think the trend setup is such you're not going to be looking to buy energy. You're going to be looking to buy Kathy Woods. I mean, where's your head leaning towards in terms of, so would you have any positions on right now? Because like if it goes straight up and you don't get this correction you're looking for, then you're gonna be like, oh heck, the long-term charts look great. I didn't have any. I'm an idiot. So
yeah, it's pretty. I'll be honest. I'm disciplined enough to not buy at these levels. That's it. Partly, I mean, my market sentiment stuff is way overdone. The charts are overdone, and I'll look for places to buy. I don't want to. First of all, anytime you're trying to force a position just because you have to get something on your sheets is bad. Focus on I want to make money. I don't need to make money. And that's how I always look at things. If I need to make money and need to put stuff on the sheets, I'm probably going to be wrong. And so, yeah, my view right now, there's other things that I want to buy. There's plenty of other things I want to buy other than oil. And I'm building a big list of things. So and I liked oil in October, before the Biden's election. And I said, Biden's going to cut production and oil's going to rip and oil stocks are going to rip. And I wish I still had, the Occidental that I bought under $10. Hey, I doubled and tripled my money on some of these, but hey, I'm not there at 50 where Buffett's buying it again, by the way. So
wait, say that Buffett is buying it again?
I think I saw a filing that Buffett was back in.
Yeah, he's
Oxy.
back. Yeah, he's back.
Back?
He's
Go ahead.
11%+ position now in Oxy.
So hold on, wait a second. So Marcellus, did he sell down or he just added to what he had?
No, he kept adding. So I think he already had warrants, and he's been buying commons now. He actually made some commons buys above $50 recently, this week.
Oh, so he bought warrant. Okay, I got it. Hey, Tommy, I just want to say, you just your articulation of how to approach markets and a thought process, that is pure gold. I mean, there's 700 people. There's 700 people in this room. It's give a man a fish, you give him a meal, teach him how to fish, you give him a livelihood, right? That is so well articulated, and I don't have to blow smoke up your backside. I know you too well, right? I need to do that. that you were helping so many people just sharing that thought process, and I can't thank you enough. That's absolutely brilliant, Tommy.
Well,
George, may I ask Tommy a quick follow on? Tommy,
yeah, go for it, three.
Yeah,
go for it.
So when I never thought Putin was ever going to go through with it, right? Because now Russia is essentially North Korea, right? And so basically once he did go through with it, I've been saying the only way out here is a coup d'état, and then now we see a couple of politicians agreeing with me. So Tommy, to paraphrase the risk reward, analysis from purely a sentiment perspective, notwithstanding any of the fundamental stuff, whatever part of it may or may not be real. Okay. Is it safe to say that from a sentiment perspective, given overbought risk reward, those kinds of things, that the risk to a negative surprise to the market, in other words, a coup d'etat or some major shift, the risk is greater than the reward here from a sentiment sort of overbought perspective? Is that a safe statement, or just from a philosophical point of view? Thank you.
Yeah, I think so. And any good news will have a significant price. Actually, let me just point it out. Any good or bad news will have a significant reaction from these levels here. I mean, that's like the dumbest thing in the entire world to say. But the fact is, crude at 96% bulls, it doesn't get up there that often, and it can stay up at these high levels. So in my opinion, there'll be dips that you can buy, and I want to buy dips. I don't want to buy 96% crude right here. It's just not where I would want to go.
Tommy, very well said.
And you know what I'll do? I'm gonna run the daily sentiment index for crude for current and in that 07 to 09 period, so you can see how it stayed elevated for quite a while and then it didn't. And
Tommy, you know what else would be really helpful? Because if you don't mind running it, I've tweeted out and I'll send it back to you. So John Roque, mutual friend, he pointed out how in the 0002 timeframe, when NASDAQ went down 80%, there were, I think, 46% of the trading days, 305 of the 647 trading days, the market actually went up. And there were many counter trend rallies, and this, bear markets are a bitch to trade. There were 15 counter trend rallies at 10%, 10 counter trend rallies at 15%. So in bear markets, the counter trend rallies could be brutal, which is, I'm pretty agnostic about the market right here, right now, because it's oversold, so to speak. By the way, sidebar, I'll contradict myself. It was also pointed out that, crashes often and pretty much only occur from oversold, weak market setup conditions. They don't occur from strength. So, you could get a complete bottom dropping out, but it's like basketball. A guy's been hitting one shot after another. He's taking 3-pointers. And when they're in the zone, it's great to watch someone who's in the zone, and like World Be Free or Andrew Toney, whatever, Michael Jordan, and they go on a streak and they just keep hitting it and hitting it and hitting it, right? And everyone will remember that famous game. I think it was the 1997 playoffs against the Jazz or whatever, where Jordan, I think, hit like 6 3-pointers in a row, and there was one classic scene where he throws up this ridiculous shot and it goes in. And as he's going back the other way, and the camera catches him, he kind of throws his hands up and shrugs like he knew it was ridiculous, all right? But when you get to the point where you're taking, and people say, what the hell is George talking about now? When you get to the point where you're throwing up 3-pointers from like 10 feet behind the line, and they're still going in, it's like, I'll shoot, I'll do it again, and again, and again. And then finally, one day, it's like one play, there's like this incredible air ball, it hits nothing. And so I think what you're really saying right here, right now, like, yeah, it could go up, but you know what? This is like not a this is not a layup. This is not a high percentage shot. Would that be a fair way of a bad analogy to describe it?
Well, when you go back to March of 2020, I think it was on the 23rd, S&P bullish sentiment was at 3 or 4, and I had all sorts of DeMark signals signaling buy. And if you looked outside and saw nobody out there in New York City, and you turned on the TV and we were going through a global pandemic and everything was going to absolute hell, well, yeah, you'd probably want to say, start talking about the apocalypse in the markets. But basically, I try to stick to that formula that's worked for me. And if I see those indicators lining up together, I'll take the opposite side at extremes. And so I think right now the extremes in sentiment are there. I don't necessarily believe that the extremes on the technicals are quite there. So it's not like I'm going to go out with any confidence and say, hey, it's a good time to short crude and wheat right now. Hey, maybe it is. Maybe you'll get a 10 or 20% pullback. It's not that much, but I think we're in a regime that is different this time, and based on the longer term charts that are in more breakout mode.
Yeah, no, Tommy, that's very well said. Just FYI, we're going to get Dennis Gartman in here next week. I was talking to Dennis this morning, and we were reliving an old funny story. I've told the story many a time, and I asked him to tell me the story again because I love stories. And it was when he was a young man in the 80s, it was on the floor of the bond pits. And I forget the name of the friend he was talking to. But anyway, he's with his buddy on the floor of the bond pits. And, bond prices are going up, they're going down. It's like crazy bedlam. It's like a scene out of Eddie Murphy in Trading Places. It's like buy, sell, sell, buy, sell. And he turns to his friend and he says, what do you think? And his friend goes, I'm flat and I'm nervous. So I think like right here, right now, I don't want to be putting on energy names right here because, if you or I got that new job, we walk in, we added here, a week from now, it's down 10% just to start the conversation. And then our boss says, hey, Tommy and George, you got any other great ideas? Like, what else do you like? You're my new contrary indicators. So I'm with you. I just think it's very unpredictable right here. So
I just think the risk reward at this particular time is, look, if you're long, stay long. I'm not, and that's just because I see a regime here that's happening, but it's just not a place where I would say here let's put,
that's great.
Hey,
Thank
Mom,
you,
let's get long crude and wheat.
Thanks, Tommy.
All right, gang, see ya.
Yeah, 3 aces. If you could just hold it, I want to get some other folks in here. So I want to do Michael K, and then KFab, and then we got who's this guy? We got Billy Big Bucks coming up. Okay, so
could I just say something real quick, George?
KFab and Billy Big Bucks. Michael K, good to see you. What's up?
Yeah, go ahead.
Michael, you there?
Yeah, I'm here. But I think someone wanted to say something.
Can I say something real quick, George?
Yeah, what's up?
Yeah, no, I just wanted to welcome Doomberg into the room and just let him know if there's a voice changer.
Yeah, no, yeah. Thanks for that. So I've been back channeling with him. I asked him if he'd raise his hand, wants to come and talk, but I don't know. He's a man of few words sometimes. So Doomberg is in the house. It'd be a real special treat if he'd come up and talk. But maybe if we all we can embarrass him into coming up to talk. So Doomberg. All right. Anyway, all right. So Michael K, and then K Fab, and then Billy Big Bucks. Hey, Michael, good to see you. What's up, man?
Hey, happy Saturday. Just a couple of comments as I was listening about sentiment. And I got an update for the Bitcoin chart we talked about a few weeks ago. I just tweeted. So sentiment, I think, one of the reasons I think a lot of people are kind of totally confused, don't have a compass right now. And I think a lot of the sentiment measures aren't so helpful, even though obviously they're reflecting the market's been beaten down. And so they appear bearish, but I don't think it's a great representation. I think confusion is the proper sentiment right now, reading on sentiment. And that's largely because we are in, at least year to date, it's been entirely a macro-driven market. Whether it's the Fed and interest rates and inflation, or now oil, Russia, Ukraine, and COVID and whatever else is set to come. It's all whipping around stocks PEs, and that's why the market's down. If you look around the world, shockingly, in the U.S., even Europe, earnings estimates, the consensus bottom-up numbers on the street haven't even come down yet. And it's shocking, but also believable if you look at how the reaction function of Wall Street analysts. They typically don't change their earnings estimates until it shows up in one form or another, economic data. And we haven't even really begun to slow yet in terms of the global economy. That's all ahead of us, or company guidance. And there's certainly been a shift in company guidance, but not broadly yet. And that's going to get a lot worse going forward. So just a point there is, again, it's been I think it's for a lot of investors, especially since, I'm in a macro seat, but I know most of Wall Street's in a micro bottom up seat. They're taught and focus on earnings. This doesn't make a whole lot of sense to them, because the companies with higher profitability and even improving earnings revisions aren't those that are outperforming like they were last year, because last year was a economic earnings driven market. Didn't have all these crazy macro swings like we're seeing year to date. So point being is that that is going to shift over this year, and really over the next 12 to 15 months. It could always be a macro driven market as long as you have these exogenous shocks happening. But I think it's actually going to make a little more sense to more people going forward, and that'll be reflected in where leadership's headed from here, in that it's going to increasingly be a function of a slowing economy and downward earnings revisions. And again, all that's ahead of us at this point. So it's just something to take into consideration about, trying to figure out what the market's going to do next, or where's leadership going to go, or where's the upside here. It's hard to see a lot of upside with a global slowdown all ahead of us again. So that was the first point I wanted to say. And then George, just wanted to highlight, I just retweeted it, a lot of conversation about Bitcoin. And I'm a guy who I would say I know nothing about Bitcoin. Not my wheelhouse, not something I comment on. But at the same time, I would argue I got a chart that I would argue that I know more about Bitcoin, where it's going, than most. And that's a lot of tongue in cheek there. But the tweet I just posted was an update of a chart. So I found basically, if you just simply take S&P high to low beta, where it's a high beta to low volatility, the ETFs, it looks exactly like Bitcoin over the last year and a half, almost 2 years. Exactly. Like day to day, the ticks, does high beta outperform, Bitcoin's up, and vice versa. So it's clearly there's a risk element involved. And there's nothing we have more higher confidence that beta is something you want to avoid, and anything correlated to beta. So that would include Bitcoin. I think Bitcoin can go down to 10,000 just looking at the chart and where beta is headed over the next 12 to 15 months. I would add to that deep value stocks, and 10-year yields are extremely positively correlated with that high to low beta trade, which I think, if we're heading into a slowdown, bond yields on the long end are only going lower. Everyone thinks the Fed raises rates, bond yields go up. That's not at all correct when the economy's slowing. That's all I wanted to say. Thanks.
Michael, thank you for those brilliant insights. I knew there's a reason I liked you. we birds of a feather flock together. That's awesome. I mean, we've been talking about Bitcoin as a risk asset, and I'm glad that quantitatively you've come up with a similar conclusion. And as far as your market view is concerned, stocks, I mean, I tongue in cheek, I've been saying the last few weeks, like, of course, I wish this Ukraine situation goes away for a whole number of reasons. Most importantly, humanitarian concerns. But then, just from the vulgar mercenary pursuit of markets, what we do for a living, like this is really a distraction. I want to get back to our regularly scheduled programming, which was, extended valuations, negative earnings revisions, people out of position owning the wrong stocks, et cetera, et cetera. And so, to me, I'm glad you refocused attention on what's really going on. So, Michael, let me just ask you a question. I'll follow on one. Given that we've got this, exogenous event, which is, dominating everything right now, for the average person in the room, do you think it's time to just like have less risk on, just because it's so unpredictable and markets are okay pricing risk but not uncertainty? And then also, you've heard me use the line before, even before this Russia thing came up. I've been saying for months that equities, offer return-free risk. Return-free risk. So, given that there's no upside, and now, just pretend the Russia thing never existed. All right, if you can do that thought experiment, if you stay in the market and you're right and you don't get hurt, like what do you win? Well, nothing. So, like from a risk reward standpoint, I mean, I'm not trying to stuff words in your mouth, but what would you say to the average person in the room? They should just be less exposed to equities, or like, what advice would you give them?
Yeah, well, and I would say everything I've already said before so far is all things I would have said if Russia had never happened, or if literally I would have said this December 31st of last year. That is only, I think, to use your words, poured gasoline on the fire and made the downturn that is coming only more likely, broader based, and potentially, pushing us into recession versus just kind of a mid-cycle slowdown. So, yeah, I think you got to be really tactical. You don't want to respond to headline news. Again, you generally, trying to trade these exogenous events is just a loser's game. And so at a minimum, we've been recommending, avoiding anything that has higher beta. And there's some exceptions to that. We are actually overweight energy. So, that's the one part that beta is okay. Financials, I would stay far away from financials. I think, that was the most crowded trade on the street 2 months ago. And now people are bailing out of it because, the outlook has shifted. And bond yields are probably going lower from here over the next 12 months if we're slowing down. So
Michael, just a real quickie on energy. I mean, the Canadian oil mafia knows they know why they own energy. I think I know why I own energy, but from where you're set, because you don't have a home team bias here, you're not a Canadian oil mafia guy. Just give us a 30-second elevator pitch on why you're overweight energy right now.
Sure. Well, I think it's a lot of similar reasons that you folks are talking about. We have an energy team that is part of my firm. So it's from energy analysts all the way up to macro energy, covering oil and gas, et cetera. So, they've been pretty right for the last year. The last year we were not bullish on energy. This year we did turn at the beginning of the year. Our energy guys have been bullish on energy for about a year and a half now, and basically talking about a lot of the things we're starting to see now. And you're seeing this is a sector where there's some positive visibility for the next couple of years due to the lack of prior investment. And then when you look at past cycles, when you're slowing down, energy is always the last commodity to fall. It's usually the one that hangs in the most, creates some demand destruction. And so just based off of historical cycles, energy is typically one of the last commodities to slow down. And then also just, the end of COVID going endemic for most of the world. So, nothing I think special, nothing, certainly not, I'm not going to add any insight from what's already been said, but I think it's a combination of those general positive, call them intermediate term trends, a couple of years, and then just financials. No, thanks. A lot of the material stocks, again, I know commodities obviously ripping here, and so it's very specific to what's going on right now. But in general, a lot of the more higher beta, economically cyclical material stocks we'd be moving away from. Industrials, when PMIs go down, so do industrials. So it's kind of by the attrition of other sectors. So if you're going to own anything cyclical here or try to hedge against any kind of inflation here, energy makes the most sense. There's no way financials work without energy working. There's no way industrials work without energy working. So if you're going to own anything, the first step is energy. And I don't think those others are going to work, but that could also happen simultaneously, as we've seen.
That's fantastic. Thanks, Michael. Always, and again, like, and Michael, by the way, you and I have to talk. I have a business matter to discuss with you, so maybe offline we can talk. So I do want to catch up with you. Oh
sure.
my God!
And I'm heading to your old friend's stomping grounds next week. So I'll say hello to anyone if you want.
All right. Well, I have a serious business matter to discuss with you, which you'll be very interested in. So we need to talk about it. All right. So
thanks.
I can't. And by the way, just so you guys know, I mean, Michael's like the top-rated strategist in the street routinely. It's just unbelievable. I mean, you get Tommy Thornton, you get Michael, you get Three Aces. We're gonna get Abe up here in a minute. You get Bob Justice. I mean, I see we got Doomberg in the audience. We have Mr. Cosgrove from Bloomberg in the audience. I mean, this is just ridiculous. This room. You can't find an investment conference as good as this. This is just sick. This is really sick. All right. By the way, I'm gonna just 1 second. Mt.Gox'ed, you're gonna laugh. Mt.Gox'ed, can you hear me? You hear me, Mt.Gox'ed?
Yeah.
Yeah, you're gonna laugh. So we get a lot of people coming up here, and I try to screen some of the questions to figure out who's gonna. If it's someone I don't know, I don't recognize, I'll ask them a question as to what they want to talk about, because in deference to everybody in the room, I don't want stupid questions. So I'm not going to mention the guy's name. I don't want to embarrass him, but you're going to love this one. I go, what is your question? This is the back channel. It's about crypto, Bitcoin, a lot to type, blah, blah, blah. I'll decline and leave you in peace. Please reply as soon as possible. He then says to me, your approach does not come across as friendly. I was like, huh? He goes, I said, Bitcoin maxis are not welcome. There are plenty of other rooms for maxis. I am very friendly. I just have no time or respect for maxis. So I don't know. I mean, it's all about number go up. So anyway. All right. So we're now doing KFab, and then Billy Big Bucks, and then Abe. KFab,
Hey, George.
Good to see you, my friend KFab.
Hey, hold on. Hey, George. Just
Yeah.
one thing. I just tweeted out the current bullish sentiment for crude and the period between 2007 and 2009. So if someone wants to post it in here, it's fine. I'm not going to leave this one up because I don't like to post the sentiment stuff.
No, I get it. I get it. So hey, could you find the tweet from Tommy and put it up in the nest, please? Could you do that, Sohaib? Or Mt.Gox'ed? All right. So who's allowed?
I did it. I did something, George.
If someone could do it, I don't know how to do this stuff. All right. Okay. Fine. All right. So we got my good friend KFab, and then Billy Big Bucks, and then Abe. KFab, how are you, my friend? What's up?
Good, George. Thanks for having me as usual. Just wanted to say three relatively brief things because we've had an ongoing dialogue in recent months when you've been kind enough to invite me up. So the first thing is I've been chronicling the global economic slowdown really since the autumn when we first started talking. And I said in January that we were entering a window of vulnerability, that a shock could tip us into recession potentially. I think everyone would agree that what's happened in the last few weeks would represent a shock. So the question now is, do we get a global recession? And I think the risks for that are off the charts. The second thing I've said is that this cycle was likely to have the crisis come from outside the U.S. and drag us down, that we were the ass end of the cycle. And I think we're starting to see that as Bob has chronicled on the call. The third thing I'll say is that we are almost 2 hours into a call talking about Europe to a significant degree. And I haven't heard anyone say that the German DAX and really the European stock indexes are crashing. And I wrote a piece in February 24th, that I put up in the nest. So this is kind of a difference maker that I have in my analytical processes, using kind of complex systems analysis to look at price. Price has been scaling in a way that suggested that this was plausible. And now we're having it. Like, the German DAX is crashing. And I think that's really important context. It's not to say that the US is going to follow necessarily. But these things, once chaos starts to ensue, can spread in really crazy ways, meaning that if you go back to 87, when the US market crashed, the Nikkei was at an all-time high and literally crashed off an all-time high. So those were the three things I wanted to mention because, again, to me, it's pretty remarkable that people are talking about bottoms and tradable bottoms potentially and setups, and literally the European markets are crashing.
Yeah. So KFAB, as always, you're on point. No one in this room is ever talking about trying to buy stuff. I mean, I've been railing away against day traders, guys looking for setups in quotation marks, weekly options. Again, in a bear market, you only can be flat or short, flat or short, flat or short. So I could not agree with you more. I guess a bad line. The next James Bond movie, No Time to Buy. Okay, so there's
Well,
nothing to buy.
George, late Friday, the U.S. market was trading as if it was business as usual. You had, volatility getting sold hand over fist, heading up into the usual Monday,
Yeah,
Wednesday.
KFAB. Okay, so I'm gonna turn it back to Michael K, because he has to deal with all these crazy clients. These institutions are pushing around the tens of billions, and maybe he could speak to it because I think these guys are nuts. They're just rearranging the deck chairs of the Titanic. So, Michael, can you speak to maybe the psychology of the investor base and like typically the kinds of questions that you're getting that would account for this type of behavior, which KFAB is pointing out?
Yeah, well, I think people are frozen. Macro investors in the first 3 weeks of this year made all their money on the trade they thought would take 6 months, which is the higher rates and the re-rating of growth stocks. And that all took place literally in 3 weeks in the first in January. And so a lot of macro investors were like, okay, well, what do I do now? Because my at least my half year or full year thesis has already played out. And so most macro investors are kind of sitting with their hands kind of just waiting for something that they can kind of have some visibility or edge on. And then again, fundamental bottom up stock pickers that focus on earnings and kind of put their heads bury their heads in the sand when it comes to macro, I think are just completely lost because the fundamentals, the earnings numbers from the consensus for whatever it's worth have yet to fall. And part of that's because the economy has yet to really slow down. If you look at PMI, the ISM just came out at 61, the new orders index at a 6-month high, which is just a bounce from Omicron. But people are looking at this and say, oh, maybe, we're going to see a reopening and we're going to see earnings stay stronger for longer and just hoping. And Carter Worth, who used to work with, had a great line, when you're hoping, it's hopeless. So again, I think there's just a lot of uncertainty now with regard to European markets getting hit harder. I think it makes sense for a couple of reasons. Their markets, number one, to begin with, are far more cyclical than the U.S. If you just add up financials, industrials, energy, materials, and Italy, I think, has got most of the energy exposure there. But Germany, I'd say, has a tremendous amount of industrials and other cyclicals that are just going to get hammered when it's risk off. And then on top of that, their financials are just getting blown up because of the contagion risk, which hasn't found its way here, and it will. And reality is, it's the contagion risk that's coming is a slowdown globally. So, it's not going to get any better.
Yeah. So Michael, I think or used to work with John Roque. I forget. You know John?
No, John used to be a client when he was on the buy side.
Okay.
Love John.
So I'm close with John, and he's now with 22V, and
yep.
I have a lot of time for John, and he's been pointing out.
He's the best.
Yeah, the crash. I mean, he does his call every week. I talk to him every other day, and he's been calling out the European market. So you're 110% right, Michael. 110%. Thanks for that. All right.
Yeah,
so
George, could I just add one thing? Because again, I want to stress this is that the thing that I'm offering up is that for example, the DAX is showing what a crash looks like. I'm not saying it's going to continue to crash, but it has begun. So this would be like seeing an earthquake start and the rippling effects of the waves start. And the question, it's not a question of whether there's an earthquake. It's whether it's a 5.0 or a 9.0.
I know. So, Fab, what you're saying is, I like to use a tsunami analogy. We're in Phuket, we're in Thailand, and we just got a phone call that the tsunami just started out in Hawaii or whatever, and just give it a few hours. And so we're not debating whether there's going to be a tsunami. It's already started. The question is, how big is it, and will it get to our shore? That's the question. So
Yeah,
tell us
and
what you say.
the U.S. market is on the beach, and the water's sucking out, and people were saying to what Michael's describing, they're paralyzed. They're not running for the freaking hills. They're standing there watching it.
No, dude, it's worse. They're sitting there with their mai tais in their chaise lounges, just taking in the sun. So And Karen Feinerman's going, well, the earnings are still good, so I don't understand why consumer discretionary stocks are going down. And, Home Depot down 30%. It's just wrong. I love when people say shit like that, okay? They're just so fucking myopic. They're not bothering to check the weather forecast. Sorry for that. All right, so let's move on. 3 aces, but if it's real quick, fine. Otherwise,
Quick question about the tsunami and hitting the shore. Nobody talks about the pigs anymore. And the debt issue over there. Just wondering, does it hit there first in the form of a question? Thank you.
You're talking about the pigs. I mean,
Italy, yeah, Portugal, yeah.
Italy.
It's starting in Italy. It's starting in Italy already, and they are not out of the ICU yet. And just keep an eye on the Italian bank stocks. They are already, they'll be the non-performers there are still not. I mean, there was some hope when rates got out of negative territory, and I just almost feel sorry for these guys because here they are again getting whacked on the head.
And
George,
this move in the dollar and commodities is a disaster for most emerging markets.
Don't forget that a lot of the non-performers at Italy, a lot of investors came in to securitize those loans and bring them down from 340 billion. They took approximately 240 billion off the books of Italian banks and securitized them to give them some breathing room. And you're going to see those issues start to widen out, on top of the fact that Italy is going to be increasing non-performers again.
Michael K.
Yeah, I just want to say something really simple. I just kind of thought of what you had asked me before to simplify the equity outlook. I think I could simplify it really easily here. You look at what's going on in Europe and even the U.S. again, with earnings estimates are going to start sinking over the next 12 months. Markets don't go up when earnings estimates are going down, or at least they don't go up much. If you look at Europe, their PMI is at 58, their manufacturing PMI. And every indicator under the sun is pointing for it to go lower for the next 12 to 15 months. So it's just starting to roll over. Stock markets, if you look, you can make a chart of the Euro Stocks Index and the Eurozone PMI. Stocks don't bottom until earnings start to recover. Or I should say, stocks don't go back up until you start to see earnings start to rebound. And so this is going to be a long time. And stocks will be volatile. They're going to be susceptible to headline risks. Every week, maybe you get a rally here or there. But the reality is we're going to be stuck in this regime of volatility, risk off for a year plus. And it's not going to end until earnings and the economy in Europe, and this is true for any country, start to reaccelerate and start heading back up. And that's, as far as we can see, a story that at its earliest is going to be the middle of 2023. And I'm not trying to be bearish and be ominous. That's just what it is. And again, this has all been very macro driven so far. We're going to get the fundamental part of the story is all ahead of us.
Thank you for that, Michael. That's awesome. All right, just to reset the batting order here. This has been a fantastic room. So we're going to do Billy Big Bucks, and then Abe, and then if anyone who's on stage doesn't want to talk anymore, if they could please stand down, just because we've got a big line here. People want to get up. So Abe, I got to go, George.
So you can drop me. This has been a fantastic room, though. Really, really enjoyed it.
Thank you, John. Please come back. You're always welcome. All right. So hold on. Let me just get some other people up here. Just a minute. All right. So we're going to do Billy Big Bucks.
Hey, George.
Billy Big Bucks is in the Witness Protection Program. I think this is probably his first time on Twitter. For those of you who don't know him, really smart guy out of Europe and the Mideast. and always has a very differentiated point of view or variant perception, as Michael Steinhardt would call it. Sometimes it's he's certainly not mouthing the Cathie Woods consensus. So I haven't talked to Mr. Big Bucks for a while, so I'm really keen to hear what he has to say. It's good to hear from you, Billy. What's on your mind?
Hi, George. Right. I mean, there's a million things I could say. The first thing, I thought your introduction was very good, and I mean, the discussion is very interesting, but it kind of is futile, given what's going on in the world. I just wanted to make a few observations on what I've heard. First on Bitcoin, which I never bought, will never buy. But I'm just wondering. I mean, the biggest, the most important place where Bitcoin is being mined is Russia, and I wouldn't touch that with a barge pole. I mean, I would think that the risk of being of seeing this thing disappear, are very very high. There could be all kind of disruptions there. There could be all kind of regulation to stop that, because obviously the Russians are using this as a conduit to escape the sanctions. So I think there's a real risk in this asset class, if one wants to call it an asset class. Another remark that I wanted to make is. People are talking about overbought, oversold indicators and sentiment indicators and stuff like that. I mean, I think all these things are irrelevant right now. I mean, first of all, in a bear market, sentiment indicators, can remain depressed for an extended period of time. A bear market is the exact opposite of a bull market, and sentiment indicators can be exuberant in a bull market for very very long periods of time, and the same is true in reverse. So the fact that sentiment indicators are depressed is not a surprise, given what's going on in the world, and given the way markets are behaving. And the same thing with overbought, oversold. I don't think they bring anything. So my personal view is that independently of Russia, we were already in a very very adverse environment for equities. Basically, the reverse of the last certainly the last 20 years, or even more. The last 40 years, we are exactly in the reverse of the last 40 years. We had 4 years of falling interest rates, 40 years of expanding commerce. Zillions of people coming to the market with China, becoming a market economy. Eastern Europe, coming out of communism as well. And so on and so forth. And so you had all these deflationary impact of all these people basically supplying things. The demographics were very supportive of deflation, productivity gains, blah blah blah. And essentially what you had for these last 40 years is you had a constant re-rating of equities, which corresponded with the decline of interest rates. Now we are in the exact opposite, and and it started probably before COVID, and COVID sort of changed everything, and actually exacerbated the liquidity phenomenon, and interest rates being stuck at zero, and people getting checks from the government, and there was basically a free for all in every single asset class, and so on. All of this is over. It's very clear that interest rates have one way to go, and that's up. Inflation, I wonder even what kind of interest rates we need to get inflation down from 7%, 5-7%. Maybe it's going to be 10. Who the hell knows? But certainly, interest rates going up at 25 bips or 50 bips a clip is not going to solve the inflation problem. And so, in an inflationary environment, you have a mechanistic derating of equities. Then, it's obviously very clear that that we are in a Cold War, and we're going to be in a Cold War for who knows, unless there is a complete U-turn in Russia, brought about by a coup, or I don't see what can change the situation. So we have a completely different environment where a very large part of the world is going to to go back to the Middle Ages, and creating all kinds of tensions. So the even not talking about the the risk of nuclear war and everything, but basically it seems to me that valuations are still extremely elevated. I think it's relevant to look at price earnings ratio. What you want to look at is price to sales ratios, because now you're in an environment where margins are going to be to contract, and that's a gimme. I mean, there is no way that companies are going to increase margin in that kind of environment with commodity prices going up so much. So I mean, they're never going to pass the increased cost to customers. So margins are going on the way down, and so what counts is really the enterprise value to sales kind of valuations. And when you look at that, whether you look at it in the US or even in Europe, valuations are incredibly stretched. And I think this whole environment is going to be conducive to to get valuations not only to to fair value, but I think to deep undervalue. We're going to go full cycle, which is something that has essentially never happened in the US. Maybe briefly in 2008 at the very bottom. Maybe the when the Nasdaq collapsed in 2001. But there's never been a full cycle, of the market. What characterizes a bear market is that stocks go down, big time. Valuations go from very high valuations to very low valuations, and they stay there. And the point is, in the last 40 years, even when we did get bear market, they were very fast, and the recovery was coming fairly quickly, because central banks were continuing to add liquidity to the markets. And this is essentially over. So I believe we're in the type of environment where we're going to see an enormous derating of stocks, and then they will stay there as long as we have inflation, as we have these the conditions that seem to be prevalent right now.
Yeah, Billy, can I interrupt you on one thing? I really
Yeah.
like the point you just brought up, and that is about the element of time. One of the things that strikes me, and you and I have known each other for a long time, I think we kind of think the same way. One of the things that really struck me is, you just hit on it, these declines are sharp and short. In bear markets, I go back to when I started at Fidelity. There were guys, Fidelity was losing. It was 1980. Fidelity had been losing money in the early 70s. And we had someone in the room the other day. Oh, it was Walter Deemer, the technician from Putnam, who's been around for 52 years. He's retired now. And he was talking about back then, like, you come into work every day and you expect the market to go down. It would just grind you down. All right. And the idea that all like pain is just short and sharp, and that's just been completely missing for the last few decades, ever since Alan Greenspan started with, never let a crisis go to waste. So when you look at bear markets, you're a market historian. I mean, I just think the investor class is like completely not prepared for what you're describing. And so could you speak a little bit more to this concept of time as opposed to price? In other words, if I give people in the room two choices, either A, door number one, the market goes down 20%, everyone gets 20% loss, markdown, and then we go back to a bull market. Or door number two, Billy, I got good news for you. The market's not going to go down 20%. It's only going to go down 5%. You'd say, oh, okay, I like that. I'll take that one. But then I tell you, it's going to do zero for the next 5 years. I mean, that time just kills people. So could you just speak a little bit more about how unusual, how abnormal the period we've seen, not just because markets have gone up so much, but also this time thing that you're talking about? I find that really fascinating. It's something that people really don't pay attention to. Could you talk about that a little bit more?
Yeah, sure. I mean, look, what we're seeing is really a classic asset liquidation phase, and it actually didn't start at the beginning of the year. It started a year ago, I don't know if you've noticed, but you can pinpoint exactly the time when the market, I mean, actually, you could say the market peaked, and that was February 16 of last year. This is when the ARK fund, all the ARK ETFs peaked, but also Chinese tech, emerging market growth, SPACs, all the crap, the Goldman Sachs, tech index of losing, of money losing companies. I mean, there started to be a very, very significant liquidation of peripheral assets, which started a year ago. Okay, and then, we're coming to this, the beginning of the year, and you're starting to see some of the large cap, the mega cap tech stocks, to get in trouble. And you got Netflix, and you got PayPal, and then you got Facebook. Stocks. They announced the slightest negative, or they undershoot slightly the estimates, and the stock goes down like 20-25% in one day. But we're talking about companies which have market caps of 500 billion or something. So I mean, it's just spectacular. And I think we're going to see that in Google and Amazon and Apple, and anything which is standing is probably going to get the same kind of treatment. And if you look at the S&P, I mean, the S&P is, has been going down, but it's been churning. So, as you said before, I mean, the market has been going up and down. But there hasn't been yet the period of time where you get relentless selling. It goes down every day for a week, for 2 weeks, whatever. And that goes to what I was saying before, is that the fact that markets are oversold is irrelevant. When you are in an asset liquidation phase, people don't care if it's if it's overbought, oversold. It's just bail me out. And so I think we probably are right at the time where where we're going to hit that moment. Maybe this coming week. Okay, you and I, we've done Japan in the late 80s and 90s, and the market. Once you got into the period of relentless selling, it just never stopped. And it went way beyond anything that people expected, and the market went from selling at 70 times earnings to 7 times earnings.
Yeah, and Billy, if I could interrupt, I remember Peter Lynch telling me he was buying like Taco Bell on 1 times earnings. 1 times earnings.
Yeah,
I mean, that's how it can go to. So Billy, let me ask you another question. People look at PEs and stuff, but you're always very good with sort of price to sales, EV to sales. And so there's obviously 2 questions. There's Michael Kantrowitz. He's not on the stage anymore, but he's such a smart guy. He pointed out there are 2 parts of the market he doesn't like. One is, he agrees the crazy growth stocks, the Cathie Wood stocks, they're all screwed. Okay, fine. But that's sort of like Captain Obvious stuff now. I mean, people know that. But he made a really good point. You get in this whole value argument. I'm going to try and channel my inner Michael K. And if he doesn't, if he disagrees, he can come back up. But his point was, it's not so much about value versus growth. It's more about you want to be short both of the tails, i.e. the Cathie Wood stocks on the one hand, and on the other hand, the sort of zombie living dead companies. And you're a graduate of the Japanese market, you know all about those. And so, and then he's like, you know what? And then in the middle, just own the quality companies. This is relative performance. Obviously, it'll all go down. But if you have to be invested, if you're going against an index, or if you're pursuing a long short strategy, be long the quality growth, be long the quality value, and short the garbage at either extreme. And so I look at the zombie value companies, and you probably have names. You don't have to mention names. Just generally, what the concept. You look at things like the airline stocks in the U.S., where your share prices are down a lot, but as you know, they've issued so many more shares and so much more debt. In many cases, the enterprise value are as high or higher than they were pre-pandemic. Ditto for the cruise companies. I mean, and people just myopically look at PEs, where if that costs not very much, you can get your earnings up. But they're not looking at enterprise values. So could you just speak to? I'm sorry to make such a speech, but I wanted to frame the question properly. Where do you see the biggest mispricings in the market? I mean, do you think it is the Cathie Wood type crazy stocks, and then also and then more interestingly, because it's less obvious, do you think a lot of these zombie value companies are really problematic because they've been carried along by a very strong credit cycle and low rates, but if the tide goes out, there's going to be a lot of bombs going off in that area of the market. So maybe you could just speak generally. Where do you see the biggest excesses, and what do you think shorting the zombie value companies like the airlines and the cruises?
Okay, on the zombie company, I'm not really good at that, George. I don't like to short stock, for them to go down to zero. So I don't. I don't have a view. To me, the biggest success are in these mega cap, tech stocks. So you look at Apple, which is trading on I think it's on 6 or 7 times sales. I mean that doesn't make any sense. You look at Apple, Microsoft, all of these companies are more expensive today in terms of EV to sales than when these, when in 1995 or something, when they were just, coming out to the market. And that doesn't make sense. I mean, it just means that the market is expecting for these companies as much growth going forward, or even more growth going forward, than when these companies were, small cap growth technology stocks. So, the downside that, I wouldn't be surprised that something like Apple goes down, 60, 70%. And it would probably still, still be expensive.
Wait, Billy. You mean, this is a joke now. You mean a stock selling on 30 times sales with 2% growth? Sorry, 7 times sales with 2% growth at 30 PE? You think that has downside? I mean, and then more importantly, so the follow-on question, more important question, if you think the stuff like Apple and Microsoft or all the index funds, and I'm going to take you back to the days of Japan and the financials, it's the usual suspects. You know the names, the Apples, the Microsofts, the Amazons, all this kind of stuff. And you've had, those 6 stocks accounting for like all the gains of NASDAQ last year. They're, I think Apple still got twice the market cap of the energy sector, blah, 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 blah. What's been holding up the indices have been those stocks. So if what you're suggesting comes to pass, you finally get to a place where you think the indices will go down. Is that what you're saying?
Oh, what do you think? No,
Albert, my grandfather. Sorry. Oops, sorry. Out of the witness protection program.
It's okay.
Billy, like a friend of mine, like my grandfather used to say, never ask a question you don't already know the answer to. Go
on. Look, I think this is the kind of environment where the S&P, can go down peak to trough, 50, 60% easy. And I'm not sure it would be that cheap.
Look, Nasdaq's up 4.6% over the last year. I mean, and people are talking about bear market, like we're not even like getting started yet. Like it's
okay.
we got a lot more
even
down.
We even European markets. I mean, they have the potential to go down a lot more. Look. You asked me about Cathie Wood and some of these stocks. I mean, the closed-end funds are down like 60, 70% or something like that. But if you look at a stock like Rivian, for example, this is a company which has got a market cap of $43 billion. I mean, that's a lot of money, and they still haven't got any sales, and they're probably going to lose money for the next 5 years if they ever manage to do any of these trucks, and that's a company which had a market cap of 150 billion. Just a few days after the IPO, again on no sales, no earnings, no prospect of earnings over the next few years. So I mean, there are coming back to zombie companies. I think there is also there are probably stocks to short among these IPOs,
right?
SPACs or whatever, which have very people think like they say, well, Rivian is down 50%. It's gone down a lot. But the market cap is still 40 billion, and with no revenues, and you've got a lot of companies like that. So that might be an interesting.
Billy, let me ask you 2 other questions. What do you think of? I know you always do a lot of good work on financials, and you look at price to deposit ratios. And so I have 2 questions for you. 1, what do you think of financials generally, and then 2, what do you think of energy?
So financials, I think. Well, I think U.S. banks are very expensive, and I would be on the short side. I agree. I mean, somebody else on the in the rooms talked about that. But not just banks. I mean, you look at what kind of business Blackstone is going to do over the next few years. When interest rates are zooming. So all of these companies and BlackRock. The valuation of if we are in a bear market. They get the double whammy. They get, people taking money out, and then the value of the underlying stocks is going down. So the AUM, go down, big time. So, these are very expensive stocks as well. So I think the financials are dead in the US. There may be a trade. I mean, in fact, there is a trade being long Japanese banks and short US banks. On energy, I think it's, I've got a mixed view on that, because we're gonna get a recession. I think there's no question about that. And so I question whether the bull market in commodities, I mean, like copper, industrial commodities, iron, and so on, is going to be sustained in a recessionary environment. Oil could very very much continue to go higher depending on what's happening, but let me say just one thing. Between the peak of the Nifty 50s until the end of that bear market in 1980, so you had it was kind of a similar environment without the risk of World War III, but you had a big part of the market which was massively overvalued, the Nifty 50s, and then you had inflation and stagflation. So that was a very adverse environment, and the S&P went down. Do you know how much the S&P went down relative to gold during that period of time?
Well, I'm going to say, what period of time are we talking about? 70s and 80s? What are you talking about?
From 74, 75 until 1980.
All right, let's say it went down 50% against gold. I'm guessing.
95%.
Can you repeat that again?
95, as in 95. 95%.
Okay.
The Dow Jones in gold terms between 75 and 1980.
Billy, you still there? I think we lost you. Billy, you there? Hey, Billy, I think your reception screwed up. We can't hear you right now, Billy. So we're gonna Billy, when you come back, speak up, because we lost you. So I think Michael K wanted to have a comment, and then we're going to go to Abe. Michael K, what's up?
Yeah, just kind of echoing what Billy, the previous speaker, said. Totally agree. And kind of what the point I was trying to make was that there's still a lot more downside left, and it's all coming from the economic and earnings side. If we think about where the weakness has been so far year to date, it's been in expensive stocks that have been re-rated due to higher interest rates. And going forward, this kind of goes to the point you were saying, George, about avoid. Okay, so you wanted to avoid expensive growth stocks with weak to no earnings, or growth stocks in general so far. Going forward, though, if it's going to be now going forward, the earnings numbers and the economy are all going to be started to go lower, lower, lower. It's going to shift to avoiding now. You're going to want to avoid the most cyclical things, which often are most of the cheapest stuff. So it kind of goes to the point with the tails. And I just tweeted a chart of small cap value, just the Russell Small Cap Value Index, the RUJ ETF. And I have a simple composite I've made with 5 leading indicators, so economic data like the ISM, consumer confidence, NFIB small business confidence, so all these diffusion indices of confidence, which haven't even begun to really decline much. And you can look at the chart that I tweeted. I don't know if anyone could put it up on here, but you can just see this thing can easily fall 40 points. The ISM's at 60 now. That can go to 40 in 12 months in a heartbeat. It just shows you the amount of downside that portends for something super cyclical like small cap value stocks.
Wow, I just saw the chart. Maybe, I don't know if someone else can put that up. I mean, Mt.Gox'ed, if you could pull Michael's tweet and put it up in the nest. It's a brilliant chart, Michael. Thank you very much for that. I mean, Michael, you're basically painting a picture where there's really nowhere to hide for the most part, no?
No, and I think most of that weakness will actually come in the second half of the year, because as the data, the slow glacial decline of economic data and earnings, it's going to take time, and It's not really so much as earnings start to come down. It's when they start to get also to a level like where, for example, the ISM gets to 50, that is right on the contractionary level. And so we're ways away from there. So, again, we can get some good news, for the markets, hopefully in the second quarter. I'm not as negative in the second quarter, actually. And again, all of this higher oil, higher rates, and all the rising prices we've seen, it's all going to hit the second half of this year and the first half of next year in terms of the economy.
Right. That's great. All right, so Billy, you're back. We lost you there for a while, so I'm not sure where you were, Billy.
Yeah, so I was out of battery. Sorry.
No, it's okay. It's okay.
Billy, hey, George, can I ask Billy a question?
Yeah. But Bobby and Billy,
Go
you
ahead.
guys we got a bromance here going between Michael, Bob, and Billy. Go for it, Bob.
Yeah, I mean, you're absolutely right. I mean, BlackRock is now down about 25%. T. Rowe Price is down about 35%. And there's a couple ones that are still hanging up there, like Schwab, Berkshire Hathaway. And so I'm looking for those to crack because it usually starts with the lower quality names first, like Citigroup. But Billy, I was surprised that the custody banks started trading off because those are not credit plays.
But Bobby J, can you name names?
Yeah, it's Bank of New York Mellon, Northern Trust, and State Street. Now those are not credit names. They have no more than about 20% of total assets in loans. And what it tells me is that market caps are going down when they go down. They're going down because their fees are based on total market caps or total assets in custody. Do you have any comment on that, Billy?
On these State Street and so on?
Yeah, or just on some of the financials that have hung up a little better, held up better than others.
Okay, actually, I kind of like the State Street and Bank of New York. I mean, they've always been cheaper than the money management firm, and in particular, State Street, which has a big ETF business, is a big ETF and passive investment management business as well is a lot cheaper than BlackRock. So, but these things are going to go down as well. One bank which has a horrible chart, really horrible, is J.P. Morgan. It's just broken down on the chart, and that would be my number one short, in terms of the financials.
Yeah, I wanted to. So Bobby and Billy, you guys should talk a little bit more about that because John Roque was pointing out like a week ago. He was pointing out the big money center banks starting to have problems, and and Michael K can speak to that. Usually when you see that, that's never a good sign. So,
yeah,
I mean, Billy, when you look. Go ahead, Bobby. Go.
Because I go back to watching Cal Fed and Glen Fed go under and going out to L.A. at that time and looking at their loan books and telling David Hensley, who was at UCLA at the time, now at J.P. Morgan, that a recession was coming in California because these real estate portfolios were getting smacked, and everybody said, "No, I don't believe it." But every time we have a recession coming, the banks in general can trade down, as much as 60-70%. And we're going to hear, well, they're well capitalized this time. And my answer to that is capitalized for what, right? I mean, I'm supposed to take solace because they have 4% more equity, but are still levered, 18-1.
Yeah, that's horrible. All right, so let's just hold it there. Billy, something else you want to say, Billy?
Oh yeah. I just wanted to say, I mean, I'm sure you must have noticed, but last week, on Thursday, all the Russian stocks which were trading I mean, the Russian stocks have been suspended from trading in New York, and the Russian stock market was closed. But in London, they were trading until Thursday, and they went down. I mean, they went down to zero. I mean, literally zero. All the Russian stocks. Okay. So I mean, basically the country is going to go bust. I imagine. I mean, the markets are supposed to open next week in Russia. Maybe the central bank is going to come to the rescue or something. But anyway, you've got a humongous systemic risk. With Russia going going bust. And I'd like to remind people that when people say Russia's GDP is only the size of Spain and it doesn't matter, and et cetera, et cetera. Even if we don't consider commodities and so on. When Thailand, the Asian crisis, which ended up, in a huge correction for all emerging markets, and actually there was a 20% hit in the U.S. and 25%, 30% hit in Europe and Japan. It started with Thailand, which is even more irrelevant than, and certainly even more irrelevant at that time than what Russia is today. So, there's an enormous systemic risk with the Russian economy and the Russian banking system. You're going to have, tons of companies going bust. The banks are probably bust. This is an enormous
You have
event.
Gazprom going down 43% in one day. Like the base
No,
company in Russia down 43% in one day.
no, but it's done 98%.
Yeah.
In February. Okay, so I think markets should be at least 20-30% lower than where they are, given what markets. I'm talking about the U.S. market, where they are right now, and then who knows, and nobody knows how this Russian thing can evolve. It doesn't look like it can. Let's put it this way: if there is an agreement in the short term with the Ukrainians, okay, the markets are going to go down, are going to go up, 10% or whatever you want to call it. I think this will be the opportunity to short or to basically exit, the markets, because I think regardless of Russia, I think we're going down, very, very big time. And as far as the how this Russian story can evolve, there's so many ways it can go wrong, and degenerate to some sort of a crazy situation. I'm not even talking nuclear, but right now I'm sitting in Israel, actually. Okay, and one of my doom scenario, which wouldn't take much actually to happen, is as you probably know, Israel is goes to bomb Syrian and Iranian and Hezbollah positions in Syria, every other day, and they do it with the understanding and agreement of the Russians. Okay, and the Russians have a way to create chaos everywhere they go, when they're not happy, and Israel is in a very, very, very tricky situation where, on one hand, obviously they support Ukraine because, one, it's the right thing to do, and two, it's the Western, part of the world, I guess, view. Okay, but on the other hand, they don't want to upset the Russians too much because, they have a problem with with the Iranians, which are which they don't want to see entrenched in Syria, and same thing for Hezbollah. I'm ready to bet that if things continue to go wrong for Putin in Ukraine, that Russia is going to stop Israel, doing whatever they want to, whatever they want to do in Syria. And that's going to, to give the green light to Iranians and Hezbollah to, possibly start a conflict. And this is typically the way Russia operates, via proxies. And so, I think the conflict in Ukraine could very easily degenerate into a very significant conflict in the Middle East. And I'm not telling you where oil prices would be going in that in that kind of scenario. And I think this is a relatively high probability scenario. Before we get to
Yeah. So
nukes.
so Billy, it's pretty wide. Biden's desperate for quote unquote a win. They'll do anything to get a deal with Iran. There'll be headline risk in terms of, more oil, blah blah blah. The oil price goes down. But for all the fundamental people in this room who follow it very carefully, it's not thought that's going to have any real long-term effect on the oil price. And so that you're right. I think there might be a little bit of a balance or respite on that. But getting beyond that, and again, your opinion, you're a smart guy, but I really appreciate your opinion because you're sitting in Israel and you hang out in Switzerland and other places in France. and so you don't have the home team U.S. bias that we have here, but you read our papers as well. What's your own, just spitballing, what's your own best guess as to how this is going to play out in terms of what do you think Putin's up to? I mean, I know we've tried to steer away from this question in this room so far, but I'm only asking you because you're in a pretty interesting situation. You're a smart guy. I'm just kind of curious, how do you think this thing resolves?
I don't know. I mean, no, everything is out in the open. There are some people saying that he's playing like the the fool's game, like crazy game, like he wants people to think that he's totally mad and that he could be doing anything, to scare everybody, off. But I think the situation is really frightening, and it's not. It's really really serious, and the people that say buy at the sound of the cannon, I think they totally misguided here, because the situation could get so much worse. So I don't see the Ukrainians. They made the media actually have made of Zelensky a rock star. The guy certainly looks like a leader, but they may have overplayed that, and so he thinks he's probably very strong in negotiating and hanging out and stuff like that. But I mean, the country is going to get destroyed. I mean, there is. I listened to all the speeches of Putin, including the first one, which was 2 hours, and the guy is I think is seriously. I mean, he's really dangerous, and I think from the very first time he said that he wants all of Ukraine, and I think that's what that's what he's going to be doing, and the question is whether they can get the Ukrainian government to agree to some kind of a deal. And frankly, the deal which is on the table, which Russia wants, would be that Ukraine be neutral, like Finland, and I think that's possibly not a bad situation actually for Ukraine to be neutral. But after what's been going on, I mean, I don't think they're gonna do that. I think they're gonna fight until the very end. And the question is whether during this fight, which is going to take some time, whether there could be miscalculations, which would lead to more problems. And I think the chance of miscalculation here is gigantic.
Yeah, Bill, let me ask you a slightly different question, because I share that concern, but I expressed earlier in the room a couple of hours ago, oh my God, I can't believe it was almost 3 hours, a different idea, which is, let's assume there isn't a miscalculation. I mean, if there is a miscalculation, I mean, God, we don't want to think about that. Let's assume there is no miscalculation. And what about the idea that, Putin, maybe they just kind of hang out in the Ukraine, maybe they don't, and I urge everyone to go look at my Twitter feed. There's a 30-minute video I tweeted out this morning from Peter Zeihan, Zeihan. He's talking about Putin's aim, to reconquer all these countries and so on and so forth. And who knows if it's true or not? I have no idea. But he's talking about, the big dislocations in the grain market, the energy markets, all the metals markets, basically what's going to happen for the world economy. Anyway, the point I wanted to ask you, Billy, is what if we get a situation just where he doesn't go after these other countries? He doesn't try to kill all the Ukrainians. He just kind of like sits there, and there's no resolution. This goes back to the question of time we were talking about before, time in markets, time in conflict, i.e., he just sits there. The uncertainty continues to build. A lot of the oil is not being taken away now because of implicit sanctions, lack of insurance or whatever. So the oil price continues to go up. Stock markets continue to tank. In other words, if I were him and I really wanted to fuck over the West, what better way to do it than, cause oil to go up more, markets to go down. And that's how you really undermine the West. What would you say to that?
No, I mean, that's fine. I mean, I don't think he's going to hang around like it's a party. I mean, I think there's going to be, let's imagine he manages to, control the cities and stuff like that. I mean, there's going to be guerrilla wars and terrorist attacks. I mean, Ukrainians are going to put bombs on, in administrative buildings, or they're going to sabotage. I mean, it's not going to be hanging around. It's not going to go quiet. So
yeah,
I mean,
you think something's going to bubble up, like the risk of something is high, is what you're concerned about. Is that what you're saying?
Yeah, I mean, I think there we're going to be. I mean, either there is some incredible turnaround. Okay, Ukraine, negotiates and they accept everything. And that doesn't make the sanctions go away. It doesn't make Putin a nice guy or everything. I mean, all the Russians and the oligarchs and everything. I mean, they locked in Russia, and Russia is going back to the Middle Ages. I mean, again, the whole country is bust. So there's going to be disruption. I mean, the end result of that anyway is doesn't change what you're saying. Is that markets are going to continue to go lower. I mean, there's no good scenario in the short term, except some kind of miracle, and somebody kills Putin or is taken into custody or something like that. I don't see how it's
Billy,
how it
Billy,
gets. I don't think
Billy.
it gets better.
Yeah, Billy, I'm glad to see you haven't changed. It's always a pleasure to be with you, man.
No, but sure. But, tell me how it can get. How can it get better? How can the situation get better?
So yeah, how can it get better? Hey, Billy, did you like fairy tales? Did you like nice stories when you were a child? I can't think of one right now.
Okay.
All right. So, Billy,
it's not gonna get better. It can stay the same.
Yeah.
But it can get a lot worse, and it can get a lot worse in the Middle East. It can get.
Yeah.
I think this is a crazy situation. I'm telling you, it's and the markets again. I don't understand. Who would want to buy anything, really. I think the best asset is probably gold. Gold bars in your pocket.
Yeah. All right, so Billy, this has been awesome.
And by the way,
yeah.
Just one last thing.
Yeah.
Okay, if I were the Russians, I mean, you were saying, they're gonna want to crash, the financial markets in the West, and
yep.
and there's a war. They're not going to do nothing. They are probably the best after the US, or on equal footing, or even better in cyber wars
sure.
and cyber attacks. What happens if they start fucking up in the financial markets, and trades don't settle, or or they start spreading rumors, all kind of rumors, or false news, or that kind of stuff. I think we could see things like that as well.
Yeah, I'm with you. All right. So listen, Billy, that's great. If you can stay,
all right.
Great.
Yeah, I'm staying. It's good.
All right, that's awesome. So I'm sure there'll be some questions for you. All right, so let's move on. All right, so I want to set an order here. Abe, are you there, Abe?
I am.
Okay, so we're going to do Abe, and then Achilles, and then Stan, and then Struan. So, Abe, always good to see you, my friend. I want to know what's in your mind, but specifically what I'm curious about, because you were talking in the other room the other night, you were talking about metals and steel, all that kind of stuff. It might be useful to the room to start with that, because that really well, and and there's a captain. I mean, everyone knows about the energy. Everyone knows about the grains. But maybe talk about some of the materials and some of the energy, because I thought that was really interesting.
Sure. So, okay, I'll start off. I've got a bunch of comments I've been sort of jotting down. Great space as usual, George. Thank you so much. Michael K. Awesome commentary, and Billy Bucks, amazing, absolutely amazing. We're getting a different perspective, and I hope to provide yet another perspective and hopefully add some value here. As I mentioned to George in other spaces, I've been involved in the commodity space for about 27, 28 years, specifically in iron ore, steel, and essentially move thousands of tons from Eastern Europe into the US market, and been doing it for, like I said, 27, 28 years post business school. And what I'm finding on the ground, as I mentioned the other day, situation's very fluid. One of the largest steel companies in Ukraine is now offline. The companies in Latvia, as I mentioned, I think yesterday, no longer taking orders. Belarus is going to be sanctioned; they're offline. Moldova is half and half. And essentially what you're seeing is a systematic shutdown or crimping of supply in the steel and iron ore market, and of course that impacts everything from met coal to oil and gas to let alone the inflationary pressures that we're going to see. I can tell you that pricing is being re-rated almost daily. There was a shitload of orders that came in last week. They will all be, for the most part, they will be re-rated again in terms of pricing into U.S. markets, and that will be no less than 20% on an increase. So I know I probably shouldn't have, but I did. I essentially said, you may want to look at certain steel companies in the U.S., which I trade quite often. One of them was U.S. Steel, and you saw what happened after that. After I not necessarily I tweeted it, but I certainly said, this is the sector. Some of the participants here, and you've seen what happened there. There'll be continued pressure. So that's sort of what's happening in the metal space. The other thing people should understand is that between Ukraine, Belarus, and Russia, they basically drive the steel market globally. Ukraine is a monster. I mean, a monster supplier. They export steel to China, so you can understand what's happening. It's the old sort of Soviet kind of economy. So that's going to be significant, and again, greatly inflationary. So I'll sort of stop with the metals, and if you guys have questions, I'm certainly happy to field those questions. But I have some other observations as well. So I lived through 2007, 2008. I was at CIBC World Markets in structured finance and securitization. Also spent years in investment banking, so I come at it from that perspective as well. And I saw the 208 the meltdown in housing in the U.S. front and center. I had a front row seat to all of it. I can tell you some of the comments that were made are actually spot on. What I would deem as priceless. I think part of the problem that we have from a macro perspective is that we have not had an entire cycle to finish naturally, almost organically. Someone had mentioned something around the duration between the beginning, the ending of a cycle and the beginning of a new cycle has been, in my view, almost manufactured, way too short. So you saw what happened in '08, and the thinking, or at least the narrative since '08, in my view, has been we've never really solved anything structurally within these economies, and as a result, you're getting almost an immediate cycle stop, cycle start, cycle stop, cycle start, and it's never been allowed to actually work through. Which is a problem. This time, I think, is a very different issue, in my view, and we will likely have to address the duration between a cycle actually completing, taking some time to work itself out, which could very well be a span of years, but I don't see it being a span of months. I think that we've pushed the can way too far, and now there's some pain ahead. So I wanted to make that point, and thank you to I think it was George or someone had mentioned about it. That's incredibly significant in my view. Another thing that I'd like to point out, and then I'll get to a very specific question that I think is we all want actionable things. The other issue is this whole notion of inflation and where the hell we're going with this. I've been reading some excerpts from various people that are speaking about inflation. I've sort of lived it for so long in various ways, like everyone else. What I kind of see moving forward, and I see it because I'm sort of globally in a global footprint in terms of the business that I do and people that I meet. The question that I have, and someone I really like someone to comment about this, is that you often hear about this notion that something it's inflationary today, welcome stagflation at some point. I'm actually going to reach out to Rosenberg because I know him personally, David, and talk to him about this. But the reality is, I actually see from, and again, this is not anecdotal, this is what I'm seeing on the ground, and elevated inflation, probably between 400 and 600 bips, on the backdrop of a slowing economy. And Bill Gross actually tweeted something today, which was quite interesting. He said, for the first time, you're going to have stagflation embedded within inflation in a weaker GDP environment, and that's going to be very, very interesting from a monetary perspective in terms of so what the hell does the Fed actually do at that point? Are they going to go back into the market, start propping it, given the fact that you've got sustained or what I would deem nagging inflation, yet we're kind of going from say 7.5% or 8%, or who knows? I'm a believer that it's probably double digit, and we go from 10 to 5. You still have, historically very, very high inflation. So I'd like someone to talk about that.
So, Abe, let me respond to that because
if I could just finish my last point, and then you guys can take it all together. My last point is that, and again, I was listening to Michael Kay, really interesting on financials, and that's a space I know really, really well. I do agree that the financials are probably, and no one talks about this, but the loan loss provisions, and that's probably the only thing I look at most times every quarter. And it'll be interesting to see on a backdrop of sort of a weaker economic environment, and you start to see loan loss provisions starting to move up. And I think it's something that is a line item probably want to continue to look at and clearly examine that. The one question I have is, again, this is something that's actionable. I've been looking at the REIT space as an inflation hedge, and I'd like if someone would be kind enough to add some color in terms of what their perspective is on REITs, given the fact that they're obviously real estate based, but it's all about cash flows, and rents are, for the moment, people need to live somewhere, et cetera, et cetera. How do they view REITs in terms of because my global thesis is that I think that every sector is going to get shellacked. It's a question of which one is going to actually come out better than the rest within the period that we're dealing with a sort of a weak, sort of nagging environment where you start to see equities fall, obviously a lot more than what most would believe. And I actually do believe Billy Bucks. I do ascribe to that. And I think Michael Kay has been very, very kind and very conservative in terms of his measure on if we should see some sort of a turnaround, might be mid 2023. I think Michael is, I don't want to put words in his mouth, but I think he's being very kind and generous. And I say that respectfully, that I'm sure he can speak to that, but it's probably worse. But anyway, I'll stop. Thank you so much for allowing me.
That's great, Abe. So a lot of good points as always. So let's deal with the last question first. Does anyone have an answer on the REITs? I don't know if Michael K or Bobby J, you want to speak to REITs? Anyone have any views on the REITs?
No, I don't. It's such a small part of the overall.
I do.
Yeah, I don't have a comment.
I could speak to it too, but I'll go last. It's fine.
Yeah, but no, Michael, you go. I don't think Bobby J has much to say. Michael, you go ahead.
I was going to say I'll go last because we have one of the things we do is we've developed this system of analytics called Macro Aware, and the idea is we're trying to impress upon our very bottom-up focused, less macro-focused investors that every stock, every industry, every sector obviously is very macro-sensitive to different macro data, and so the idea is how macro aware are you, or is your portfolio? And so one of the things we have is whether for stocks or industries, for sectors, ETFs, we could pull up any one of 100 different market or macro data sets. For example, let's use CPI here within real estate and see, what are at least the last, let's say, 5 years, what's the correlation, what's the relationship between rising CPI and these different stocks. So just got to give me can we come back to me so I can give an answer? I'm just pulling it up right now and I'll be able to give it a quantifiable answer.
Yeah. Bobby J, do you want to say anything on REITs?
No, such a small part of the overall market that I don't really follow them. No.
Yeah. So for myself, I would just say I would just not to be dangerous. Similar to Bobby, to me, it's a smaller part of the market. They have much attention to it, but I think you have to differentiate very much between different subsectors of the REITs. And so, if you just look at the REIT ETF, you got to be careful. I haven't looked at it recently, but I remember looking at it in the past. It was dominated by, American Tower and Crown Castle, whatever. Really like cell phone plays. I mean, it's wireless plays. So, yeah, it's more like growth stock type stuff. Then that's compared to office REITs, which are a fucking disaster, compared to apartment REITs, which are okay, compared to industrial REITs, which are filling up with Amazon fulfillment centers. So I think it's really a hodgepodge. And
I would say housing, George. I would look at traditional housing, given the fact that at a basic level, people are going to need to live somewhere. And
So maybe that would make sense, but that really is getting this house specific, because it's just stock specific, because that's a really small subsector of a REIT sector. So I don't know if anyone has any particular views.
George,
Maybe Michael K will come back with an answer on that. But I haven't spent a lot of time on it, just because compared to all the bigger issues that we're dealing with, to me it just seems like small beer. Let me go back to the bigger question, the other question you asked, the first one, which I have very strong feelings about. And I don't know what, I heard you say about Bill Gross tweeting stuff out. It's exactly been my view. He must have been reading my thoughts. And just as, you have this idea that all things being equal, more growth means more inflation, and less growth is less inflation, and blah, blah, blah. But you also got to think about supply shocks, demand shocks, exogenous shocks. And, we went through this period of, there are a whole bunch of other things going on, be it globalization, increasing application of technology, all this other stuff. You had the Eurasian savings glut and blah blah blah, and so big technology application. I have to have some more caffeine to rattle them off more effectively. But there are a whole bunch of factors that came together which brought us to great moderation. And I believe that movie's running in reverse right now. Even in the context of, if you think long-term disinflation, blah, 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 even if you believe that, I think cyclically you're looking at an inflationary environment, because you've got deglobalization, you've had underinvestment in a lot of extractive industries, energy, and a lot of other materials. In the United States, you don't have enough labor, at least not enough labor. You've got a skill mismatch. There are, record amount of unfilled jobs. There's a bunch of other things. There's a whole bunch of cyclical things. You got ESG, you got infrastructure, all this other crap. You got a whole bunch of factors coming together, which I think cyclically, assuming the world doesn't come to an end, I know we always talk loosely, what if we get World War III? Well, now it's not a joke anymore. But assuming the world doesn't come to an end, there are a whole lot of reasons why I think inflation is a problem. It may come down, but it's going to stay at a reasonably high level. And also consider that the Fed, I don't care what scenario you're running, and I talked to Stephen Roach, who worked at the Arthur Burns Fed, or read Henry Kaufman, or whatever. We are running a wildly stimulative monetary policy in this country, with rates so far below inflation. So, no, I think inflation is going to be persistently high. I don't pretend to be a bean counter, but the people that follow these things more carefully than I do. I look at the Ed Hyman stuff, and the next couple of months are going to be particularly bad. But forget about that. Looking well beyond that, I think we're in an inflationary environment. Period. And all the people at these hedge funds that get raw because of their beloved long duration IPE stocks, I think Billy Big Bucks has got it completely right. So thank you, Bill Gross, for validating my point of view, but that's been exactly my point of view. Michael, did you come back with a answer, or you're still working on it, Michael?
I'm still thinking. I'll tweet it so I could share it visually.
I'm going to give you my REIT answer.
Go ahead, Billy.
I wouldn't touch it with a barge pole.
Reason being?
The reason being that interest rates and inflation. Inflation in one thing is okay, but interest rates are going up. The REITs are selling on rental income yield, or FFO yield of 3-4%.
maybe less for industrial space and so on. And this is not going to compete with where long-term interest rates are going to go. You don't. I mean, REITs don't go up in a rising interest rate environment. Period.
No,
Excellent, Billy. Excellent.
I know that.
Abe,
Yeah, I'll just make a quick point. I'm well aware of that. I think the issue is when you're looking at a basket of sectors. My perspective is that they are all going to underperform. It's just that some are going to underperform less than others. And I guess the real question.
Abe, I don't know you well enough, but I'm going to try a bad joke here. Abe.
Yeah.
We already know who the best looking girls in the bar are. Okay. It's energy, and we know who the ugly ones are.
No, we know that. Yeah, we know
that. Okay. So you're now trying to pick out some. You say, well, let's pick out. I'm going to be accused of being a sexist. Okay, like who cares what the 4s or the 5s are? Okay, we know what the 1s and the 10s are. Like you're in the middle part of the playing field. It's just uninteresting. Like why bother? Would be my question.
I've got a good one for REITs. You want the ones that specialize in caves, deep underground.
Yeah, we have a lot of those here. We're good. Thank you.
Abe, I don't know you well enough. This is in basketball. I say, dude, you're trying to force a shot. Like, you got so much better stuff to play with. Like, I don't know. I mean,
I don't know. I'm just, I'm just looking at a broader picture. I'm not a type of guy.
I hear you. I get it. I get it. Okay. All right, let's move on.
Hey, George.
Yeah.
Just real quick, I'm off, but thanks for an awesome room, George.
Hey, you were fantastic. Thanks so much, and come back again. See you soon.
Yeah.
Michael K, what's up? What's up, Michael K?
Yeah, so I have an answer, but it's one of those tricky things. It's hard to get to, but it actually made me think of something, which I think is going to be very relevant to all sectors and all industries and all stocks. As we, you try to think about if you believe inflation is still going to be an ongoing issue, or CPI could still go up. How do you position for that? So one of the things you got to be careful with, and I'm saying this about our own tools here. So again, correlations can only be as strong as whether or not they're relevant in the current time you're looking at versus the historical time. And so one of the tricks with, if we're looking for stocks that have outperform when CPI goes up or have a positive correlation to CPI, the problem is that in the last 30 years, inflation has been very pro-cyclical. And so what you end up with a lot of cyclical stuff, just because usually it's the economy getting better that creates inflation, and the economy slowing that takes it away in the last 30, 40 years. We haven't seen this stagflationary environment since the 70s. So you have to have the right empirical data set. So the point I want to get to is that you got to be careful of that, number one. And number two is the answer to, I think, going forward, how to position for, or if you're worried about higher inflation, is really about just being defensive and positioning for slower growth, because those are the two macro forces we're facing, or trends we're facing: higher inflation, potentially, and certainly a slowdown, with high likelihood. I'd say more conviction in that than where inflation's going. And so if you got those two things going on, at the end of the day, market's going to be risk off. We're going to have a growth scare later on this year. And so it's really not so much about positioning for higher inflation. It's really just about being defensive. So, but within REITs, there's 12 different industry groups. And so it's generally the services, retail, some residential, it's the groups that do better, that are more defensive and a little more stable compared to the industrial REITs. Hotel REITs are the highest beta. Everyone wants to buy those now because everyone's going to travel. Well, everyone knows that. And if beta is going to be a factor that people are going to, if we're worried about a slowdown, high beta groups like hotels and resort REITs are going to struggle as demand slows. So just my 2 cents there.
That's also makes a lot of sense, Michael. Thanks for that.
Michael.
All right. I want to move on here. So we got 4 speakers. We're going to do my friend Marathon, followed by Achilles, followed by Stan, followed by Struan. So Marathon, good to see you. What's up, Marathon? Marathon, we can't hear you. Marathon. Hello? Hey, Marathon, tell you what, why don't you leave and come back? I'll let you back in. There's something wrong with your mic. I don't know what the problem is. Marathon, can you hear us now? We can't hear you, Marathon. Is a problem. All right. Why don't you leave the room and come back, and I'll let you back up right away. Give you first in line. Let's go to Achilles. Achilles, what's up?
Hi, George. I'm working in Germany, and I've had a call on Friday with our office in Poland.
Yes.
And the head of the Poland office told me that all 5 Ukrainians working for him, it was on Friday, quit the Monday before and all went together to Ukraine and will fight. I see that as Putin made a massive miscalculation and is facing a second Afghanistan. This is happening all over Europe. Ukrainians are returning to this country and fight. They will lose Kiev and there will thousands and thousands of dead Ukrainians. But the point will come when the Russians have enormous losses. Whatever may happen with Kiev, they take the city and they take other big cities. This will be like Afghanistan for them. And this will, I mean, he sent them back to Stone Age. Basically, they are fucked. The Russians. China is now buying the gas with 18% additional discount. it's massive, and I just want to say that is really massive what's happening there, and the one that's profiting is China again.
Yeah, that's enormous. Achilles, thanks for that. Could you please explain a little bit more? As you're sitting in Germany, could you share with us, because mostly Americans and Canadians in this room, could you explain a little to us with how the average German is looking at the role of the U.S. and NATO as opposed to Russia? Because I think what's been a surprise for many of us here is how sympathetic a lot of the Germans are towards the Russian point of view. And I understand, you look at the historical connection between Russia and Germany. How is a typical German looking at this situation right now?
Well, I think it's a very long story. I don't think that most Germans have more sympathy for Russia than they have for the US. I think that is just not true. I think it's in Germany we say the one that screams the loudest is the one that will get what he's screaming for. But I don't think it's a majority. The US lost a lot of reputation with the Iraq War and the weapons of mass destruction that were never found. And also when I think it was with the Snowden case that when came out that Obama spied more on Merkel than he did with Putin. I think this were hits in US reputation in the German population. At the moment, it's obvious Russia is the bad boy.
Right. Can you hear me, Achilles? Can you hear me?
Yeah.
Okay. So maybe you could speak a little bit about how. I've been reading up a lot about how Germany, in particular, and Europe in general, got on this problem with the natural gas. Where the guy before was Schroeder or whatever, before Merkel, signed these deals and he became head of Gazprom Europe, blah blah blah. Like how much? What do the German people think about the fact that now they're totally beholden to the Russians, that they're so dependent upon their natural gas from the Russians? I mean, to me, I'm scratching my head. I'm like, what were they thinking? I mean, what does the average German think about that? And what does the average German think about how much their electricity and energy bills go up?
So I think this dependency on Russian oil and gas is a long story. It started in the early 1970s. The German approach was to instead, you Americans have an ocean right and left from you. We have borders with countries that are straight close to us. Ukraine is 1,000 kilometers from Germany. And the German approach was we will have to deal with them anyways. So we tried to get them into as much business as possible so that they can't break it. And this was, as we see now, a miscalculation from the German government over decades. So the approach was to make as much business as possible, so they can't go to war with us. The average consumer is fucked now. We have to say it. I've posted in your yesterday space a photo from the gas prices at an Esso. It was, I think, in the peak 220 for regular per liter, euros per liter, and I don't see how it's going to decline. It's the average person is fucked in Germany. Let's say the energy we take now. You have to see it that way. We have the Green Party in the government, and this Green Party was founded as an anti-nuclear energy party. They are now thinking about going back to nuclear energy, or at least keeping it running longer. There are major shifts in Germany at the moment.
So are you saying the situation has become bad enough that possibly we get a rethink on some of this green craziness?
I think that is too early, but the point will come. You have to see that in Germany, you have like 65% tax on gasoline. It's not an open market as you have in the US. It is government dominated. It's like for electricity, it's 50% is tax and 25% is regulated by the government. There's only 25% open market for electricity.
Right. So that means when the market price goes up, the net price to the consumer in percentage terms does not go up as much as it does in North America. Is that correct?
Yeah.
Right. Okay. Right. So the first story you said about your friend with the 5 Ukrainians going back to leaving and going back to Ukraine, that's really, really interesting. So again, it's just your opinion, I realize, but what is your best guess as to what Putin's going to do? What do you think is going to happen?
Sorry, can you repeat it?
How do you think the situation will develop? What do you think Putin will do? What is your scenario? What is your best guess?
Well, I have my backup bag in the car. Let's be clear about that. I have the
I'm sorry. What's
in my backpack?
Okay. All right. That's your answer. Yes.
No, I mean a war between NATO.
I think we lost Achilles. All right, let's move on. He'll come back. We'll go to Stan and then Struan. No, we're gonna do Marathon because Marathon. Can you hear me now, Marathon?
I can hear you. Can you hear me, George?
Yeah, we can hear you now. Perfect. Okay. So, good, great to hear from you, Marathon. So, Marathon, Stan, and then Struan. Marathon, good to hear from you again. What's up, Marathon?
Hey, really appreciate you having me on. These spaces are great services you're doing for folks. I'm going to give 15 seconds of background. I've been managing natural resource funds for almost 30 years. Started at the Franklin Templeton Group, and most recently was at the Tocqueville Asset Management. Worked alongside some pretty sharp pencils like John Hathaway in the gold space. What we're seeing right now is unprecedented in the markets, but I wanted to take a quick step back and go through just a couple of things, and I'll try and do this quickly because I know we've been in this room for a long time. You know, the commodity bull market was happening well before the Ukraine happened, and it really was a supply-driven bull market. If I have just posted on Twitter 3 charts that I'll try and speak to quickly. The first of which is just looking at CapEx across the entire natural resource spectrum. And from 2010 to 2015, the companies that make up the S&P Global Natural Resource Index were spending about $500 billion a year to build up the productive capacity in the commodity space. Because of the oil crash in 2015, the movement of ESG, all the other things that we know have been impacting these markets, that spending fell by over half. So, now instead of spending $500 billion, you're spending somewhere between 150 and 200 billion. That is not enough to be able to replace the ounces and pounds of all of the commodities out there, particularly when we're actually consuming 20 or 30% more of this stuff than we were 10 years ago. So that's, I think, the focus on the big picture. All of these markets were going to go into severe deficits sometime over the next 2 to 4 years. Ukraine just pulled that forward and brought those pinch points forward, and it's exacerbating himself. There will be people who think that whatever resolution comes in Ukraine, if it comes quickly, that is is going to mark commodity markets top. It will, no question, in the short term, because I think people are positioning in these things defensively. But what we've also triggered is a reversal of inventory complacency. So people used to be fine carrying low levels of inventory. That's done. We're now reversed that to a hoarding reflex. So the issue with getting more capacity online to where the world needs them to be in the next 3 to 5 years is we just haven't done the legwork. We don't have the projects that are 2, 3, 4 years through development to be able to get online in the next 3 to 5 years. So that puts us in a really tough spot. So I think the base case for investing in resources is very strong. The next two charts that I have in there kind of illustrate from a valuation standpoint. So I would first look at there's a Bloomberg chart looking at the S&P versus the GSCI commodity index. Look, we're still at super low levels. This is not a timing indicator, by the way. And I'm not saying that we're going to go back to 7 or 8 on this ratio, but we went from a low of 0.5 back in early 2020. We're back to 0.9. Where this ratio has typically lived most of the last 50 years, when you go back to 1970, has been 3, 4, 5, 6. It peaks typically at kind of 7 or even as high as 8. I don't think you get back to those levels, but if you did, that would mean that oil would sell at $1,000 a barrel. So it can't happen. So some combination of the S&P going down and commodities going up. As important, I think, is how commodity stocks are being valued versus the broader market. And George and a bunch of our other speakers, your Canadian Energy Mafia, have spoken about this a lot. So the other chart that I posted on there is from GMO, who I think they do fantastic work across all markets. I think they've done really good work in the resource markets. Lucas White is the manager of their resource funds, really, really bright guy. They look at 100 years of history of resource stocks relative to the S&P 500. And again, if you go to Twitter, or I don't know if anyone can put these charts up in the nest, the ratio of valuation for resource stocks versus the broader market has typically kind of gyrated around, a 0.8 ratio, so kind of a 20% discount. They've gone as high as a 20% premium. And before COVID, they went as low as about a 60% discount. COVID pushed us to an 80% discount to the broader market. And even with resource stocks doing really well over the last year and a half, we're still at about a 70% discount to the broader market. And it's because resource stocks are going up a lot, but the earnings are actually going up a lot faster. So I think the big case for resource stocks is, are we still early? Quite honestly, I'm fearful that I'm not sure how much that's going to matter in the next 2 or 3 months. There's another resource guy. Again, we all you have to give credit where credit's due, because all commodity managers have kind of been together in the bunker and had, our teeth kicked in for the better part of the last decade. But the guys at Crescat, Tabby Costa, had posted something a few weeks ago that was, look, we have the debt levels of the 1940s, the inflation of the 1970s, and the valuation of the 1990s. The only thing I disagree from there is I think we got the inflation more like the 60s. I think we're a couple of major policy errors away from something like the 70s in terms of inflation. But but we could certainly get there. What I would add to that is I think we are now entering just what we've seen in the last couple of weeks. We've got the geopolitics of the 1930s. Which is really dangerous, major superpowers kind of batting heads. And we've also got market structure not too terribly different than what we saw in 2008. It's not because the banks are as over their skis as they were, but it's because we've got the banks having pulled back so much. Your traditional channels of liquidity providers are gone, you've got these crazy, massive passive flows that are sort of reflexive. And so, I think that's all just really, really dangerous. I think it's 100% adults only in the pool right now. And if you're holding a portfolio in such a way that you're not excited to see everything in your book go down by 25 or 30%, you're too long. You gotta play better defense than that, because I think where we are is very dangerous. So the last point I'd like to talk about is why the big institutions are being so slow to pivot to embrace resources again. That's a relatively quick one, but I just want to stop and make sure I've still got some time here to work with.
Keep going, Marathon. You're doing great.
All right. So here's the problem: that the big institutions and endowments have been burned really badly twice in the resource markets. The first time was you had in the late 90s and early 2000s, they came out with the GSCI, this great big commodity index that was uncorrelated. You could invest in inflation. It had, I won't go too much into the weeds on it, but you had a positive roll yield because of the shape of the forward curve. So you had this great non-correlated high return asset, and they sold everybody on it in the early 2000s, and it worked really well for about 2 years. And then the curve shifted from backwardation into contango, which means your 3% tailwind turned into a 3% headwind. So you had hundreds of billions of institutional dollars flowing into the commodity space that all of a sudden the tailwinds turned to headwinds, and then you had 2008. So they got hosed, and they lost hundreds of billions of dollars. Then they got sucked back in with the American energy renaissance in 2010, where you had private equity and energy credit go out and raise $300, $400, $500 billion to invest in shale, and gigantic numbers. And what happened between 2010 and 2020? That $350 billion of equity and about $150 billion worth of credit did nothing in one of the strongest bull markets that you've seen in the history of other asset classes. And worse yet, they had a bunch of BS marks on them going into 2020. So right when the pensions and endowments needed them not to go down, they all got marked down 30 or 40% at the end of Q1 in 2020. So they have been burned twice in the resource sector. The big institutions and endowments are very slow to pivot. And if you burn them twice, it's like, burn me once, shame on you, burn me twice, shame on me. It is going to be very, very hard to get these folks back to the table to invest real money to allow resource companies to be able to expand production. So I think it's going to be really slow. I think ultimately that's bullish for the resource sector. But it's going to take a ton of time, and it's really what makes this bull market likely stretch out a lot longer than anyone would expect, because the cure for high prices is not high prices if no one's willing to invest money to add to your productive capacity to take advantage of those high prices. So I'm gonna put it on hold there.
That's great, Marathon. Thanks so much for that. Let's keep moving here. We're going to do Stan and then Struan. And I see we have Mr. Metal himself, King of Coal, Andrew Cosgrove, who hasn't spoken. He's in the house. And then O'Hare. So Stan, welcome. What's up?
Hey, George. I want to thank you for having this room and a phenomenal set of contributors. I know you do this frequently, and it's definitely a great value add. So I urge you to keep doing it. I agree with many of you guys that there's a lot of risks right now that people aren't reflecting. And I don't have the same background as the rest of you. I come from running startups and having invested in some, looked at thousands. But I do kind of want to maybe, even though I might not fully believe in it, present the other side of what could happen here that we're not hearing. So if we go back to the pandemic, authorities realized, hey, this is a major issue. How do we approach this? And they used some tools that we hadn't expected. It would not surprise me if Europe realizes that they're in a major, they obviously realize they're a major problem, but they might switch to actually bringing on tools that we hadn't expected to help solve things going forward. I don't know what those tools might be, but both to tackle inflation, but to also tackle the inflation or the counterparty risk. So, for example, they might make a bad bank where a number of people can take their business with Russia and put that into the bad bank or the bad entity, EU centric, and essentially get full credit for that, or a lot of credit for that, which then institutionalizes the risk of what happened with Russia. So I think that there's a fair chance that happens. Likewise, in the U.S., if we think about inflation, I don't think that the traditional monetary tools are the only way to deal with inflations. I think there's a lot of smart people in the world, and I think if they get together, there's alternate ways to do it from an administration perspective and not just rely on the monetary side. And that's similar to the transition from a monetary response going forward to how do you control things to a fiscal response. We saw it really well in the pandemic response. The fiscal was clearly, there were a lot of mistakes made it, but we did avert a major breakdown. So I think that from that perspective, there's some hope going forward. The other thing I wanted to talk about a little bit, and probably some people won't like this, but having looked at startups, the idea there is you think about, okay, where is this company going to be 5 years, 10 years from now? And what we have in the U.S. market is many times we try to look at, well, what's the situation going to be like 3 months, 6 months, a year from now, and haven't been really thinking. Or some people in certain sectors haven't been thinking 3 years, 5 years out. And I think Marathon just brought that up, that the commodity sector, people haven't been looking as far forward as maybe they should be. It's been really short-term focus. Contrast that to some of the higher multiple names where people are realizing, hey, 5 years out, this company is going to be generating a massive cash flow, and valuing it just on its most recent earnings don't make sense. And so I caution, and I hear it a lot, that, oh, this such and such a stock is way overvalued because the recent earnings were wrong. Well, the reality is we misvalued Microsoft, and it was rather obvious that, as an example, Office is a utility that saves us the time value of money of using Office is so high, they're undercharging that right now, and for that. And as we have more middle class, more office workers throughout the world, more people are going to need to use Office because it's just so much more effective than any of the alternatives there. And the cost of 30 cents a day is neglectable for how much power it provides people. So if they increase that from 30 to 50 cents, that's a massive revenue increase for them. And it makes barely a difference for everybody else. So I also, with companies like Microsoft that get paid sometimes in advance, the way that you think about valuation is a little bit different. Now, I'm not saying that the Cathie Wood stocks rightfully should be valued at really high valuations, or that I agree on the valuations of certain car companies. But I do think the way you think about SaaS companies should be different than in the past. And I know that this is not generally the way that people think about it in this room, but what I'm saying is that trying to look historically at PE ratios and justifying where things are going doesn't necessarily work when you have these companies that have a completely different model to how things work. And so with that, the risk is that with all this innovation, that companies are going to get disrupted. So if there is a better solution to Office that comes out, probably that's a hard one to crack. Microsoft could see a huge matching cash flow disrupted. So there are risks in a variety of different spaces, and that's one thing that, so you see these different sectors of the economy, some being only viewed at 6 months ahead and some being viewed at 5 years ahead. So I do think that the multiple should be higher broadly than what we look at historically for companies that really are forward looking and have a good 5-year strategy. So with that, I know that people might do things differently, but thanks for letting me share my thoughts. I do agree that we're overvalued, but I don't think that we should be completely pessimistic on everything.
Thanks for that, Stan. Well said. All right, so we have 1, 2, 3, 4. We have 4 people left to speak. I want to close this room at a certain point. We've been going at 3.5 hours already. I don't know what is it with you guys. You just love to talk. We all love to talk. We're all students of the market. We're all learning here together. But I gotta get a life. So, and I woke up today not even sure if we're gonna do a room. So there you go. So I think we're doing Struan, and then O'Hare, and then Andrew Cosgrove, and then Storm. Struan, hello, welcome to the stage. What's up, Struan?
Thanks, George. Really appreciate it. I was up earlier, but my wife called me to dinner, so I had to go offline and come back again. So thanks for bringing me back up.
Yeah, by the way, I have to interrupt you. So one of the first question I have for you is, because I had this question asked to me. This is a joke now. It's not a joke. It's serious. Someone was saying to me, how do you guys do this without like having your wives kill you? So like, do you have a trick? Like, do you lie that you're on a business call or something like that? Like, how do you get away with this, Gerard?
My wife's from Chile, and for anyone that has a South American wife, she came into the room and she had eyes like those kind of eyes that people with wives know. I knew I had to hang up pretty much immediately. I just told her I had an opportunity to speak on something, and she's giving me a little bit of grace. So I'll I'll get out what I have to say, and then I might have to log off again. But it's Saturday night here, so really appreciate the opportunity. 20 seconds on my background. I funnily enough, since my company was mentioned, I worked at Northern Trust for 10 years in the 90s and early 00s. I was on the trading floor at ABN AMRO when we were taken over by RBS, and that went under, as everybody knows, during the 08 crisis. And then as a sucker for punishment, I went to work for Nomura after they acquired Lehman's European operations. And I'm now back in the relative safety of Northern Trust, working for their branch in Sweden, where I am. So I'm a Scotsman based in Sweden, and I thought I'd share a little bit of the European perspective that I see. I mean, I think, having lived through the 08 situation, my kind of perspective right now is that this eclipses 08 by some distance. I mean, that's definitely not reflected in short-term asset prices, but I think in terms of its long-term implications, it far outweighs what happened in 08. The reality is we just have so much to take in and so much to analyze. I mean, firstly, some reflections on Sweden, and then a little bit more back to Russia, Ukraine. In Sweden, I think my feeling is, and I'm not Swedish, so I don't purport to represent, what Swedes all think. But my feeling is that there's a growing sense of panic mixed in with a kind of a bizarre kind of keep calm and carry on attitude, which is very Swedish in nature anyway. We're weighing up the potential of a nuclear disaster. So, probably a higher concern in people's minds is what happens if a bomb accidentally hits one of the nuclear power stations, as we heard sort of nearly happened recently. They're much better protected nowadays than they were in the Chernobyl days, but we're really close. All the European countries are so close to these things that, if there were to be such a disaster, it would create a much greater degree of panic and disruption. But we're weighing that versus the potential for the use of nuclear weapons, and we're weighing that against an already, pretty significant rise in energy prices, and now a big run up in food prices. And I this is pure speculation, but I went to the shopping mall today with my wife, and we were just buying some plants because we've moved to a new place in the south of Stockholm, and the supermarket was super busy. There was a line of cars right outside, and it's funny because I woke up this morning thinking, I wonder what the food prices are going to do in the supermarkets, and should we be stocking up? And sure enough, it just felt like it was a little bit busier. That's pure speculation, but keep an eye on the news reports. But as I come back to the macro picture, for me, it's how does the macro go into the micro, right? So Russia, as we know, is going to a zero kind of asset level MSCI, and all the fund managers are being asked to price their assets fair value at zero. And what does it mean for the world if a country whose assets are effectively coming down to worthless is starting to be the country that's controlling Ukraine, and has the market fully taken into account what Ukraine is. It's so easy to think of it as a faraway kind of minuscule part of the market, because admittedly, Russia, and Ukraine are not huge parts of the global economy in terms of, where they show up in indices and so on. But, think about Ukraine in terms, and I got this from the mining. I subscribe to this great newsletter. I'm sure many people do that are in the natural resource space, Mining Stock Daily thing, and so I'm sort of unashamedly lifting it from them. I hope they don't mind. But Ukraine, we're learning about Ukraine's position in the world, right? So the first in Europe with proven uranium reserves, second in Europe and 10th in the world with titanium ore reserves, second most explored reserves of manganese ores in the world, second most reserves of iron ore in the world, second most reserves of mercury ore, third largest reserves of shale gas in Europe, seventh, of coal, and the list goes on and on and on. Corn. China imports 90% of its corn from Ukraine. Can you believe it? I mean, and that's for their pork and so on consumption, and it's a huge list. We've talked a lot about wheat on this space, but the list goes on and on and on. So you're looking at a country that is hugely significant to Europe, and now I think what you need to kind of dissect and pick apart is how do those inputs start to affect all of the industrial companies. They don't affect funnily enough, because of that indices issue, they're not affecting financial companies quite as much, right? They'll affect emerging market managers and so on and so forth. But from a portfolio perspective, exposure to Russia and Ukraine is relatively limited. But when you start to look at the corporate and industrial environment, and you look at all these inputs that are fundamentally coming from Ukraine, I think that's the big question for me, and in particular in the context of a country whose assets are going to zero and are trying to take control of that country. What does that mean for the sort of European landscape? Ironically, as people have said, we may well see a rally on good news, markets, but I think we're going to just see a huge amount of noise. And my biggest concern is the bottom falls out of it because of Ukraine's significance to the world in terms of its commodities and so on. I'll stop there.
Thanks for that. That was great. Maybe some questions, but
Just a comment.
I find myself largely in agreement with pretty much everything you said. Who wanted to speak up? Who was that? Go ahead.
Yeah, Zabe, just a comment. You basically confirmed my own thesis in terms of moving iron ore and steel out of the Ukraine. That's exactly very, very accurate. And I think what is being underappreciated is, again, the inputs to production in other jurisdictions that are very much reliant on the Ukraine and Russia. And again, I'm seeing this not anecdotally. I'm actually living it, where you're getting stuff repriced, and these are in the many millions of dollars in terms of orders. And what is also happening is a scarcity, because it's now becoming offline, or they've gone offline and scarce. You're seeing a real rippling. So again, a key contributor back to the whole inflation story. Great comments, grossly underappreciated, and I just want to say this on a personal level. It makes me crazy as a math guy to hear this constant. Russia's whatever $1.5 trillion GDP, and Ukraine is a fraction of that. It's sadly it's nonsense, because it's the inputs that they have, that they export, that are going to drive the real sustainable inflation, because you already have supply shortages, or what I would call compromised supply structures in place, because of many, 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 many years of underinvestment in capex. And now you've got a perfect storm. So I'll stop there, but I think you guys get the message.
No, Abe, 100%, and we talked about this in other contexts as well. And just going back and fishing an article right now. Here's a bizarre one. I talked about it early in the conversation. So Ukraine, it says Ukraine war flashes neon warning light for chips. All right. So Ukraine is a major producer of neon gas, critical for lasers. used in chip making and supplies more than 90% of U.S. semiconductor grade neon. All right, so it's I think Three Aces when you're early on talking about same thing you were talking about. It's like, you know, it's all the little things that go into processes, and the supply chains are just all over the place. So we haven't begun to think about that. So no, I completely agree, and I just again, equities continue to represent return-free risk. We should be thinking of that's even without all us turning into vapor or water because of a bomb. It's just there's so many ways to lose, so many things that can go wrong, and if and when this thing ever goes right, it's going to take a long time to sort this out. So, I think Michael K's point, and he's going to come back up about, you know, we've yet to filter to discount the downgrades and all that kind of stuff, 100%. And here he is. So, Michael K, do you want to weigh in on this? Michael, can you hear us, Michael? Michael K, can you hear us? Abe, can you hear me?
Yeah, I can hear you.
Yes.
Yeah, I don't know. Michael, you got to unmute yourself. I don't know. I got him back up here because I really wanted to say something, but I don't know if he realizes he's muted or whatever. All right, hopefully he'll speak up while we're talking. Anyway, those are fabulous points. Thank you so much for those points. All right, so we're going to go to I think it's O'Hare. Strong, that was great. We're going to do O'Hare, and then we're doing Storm City. And then in there, if Michael can unmute himself and get his thing to work, we want to hear from him. So, O'Hare, always good to see you, my friend. What's up?
Hey, likewise, George. Fantastic conversation. A lot of great speakers in here today. So I kind of look forward. You should run this room every Saturday morning. I can have my cup of coffee and my donut.
By the way, O'Hare, let me ask you something, because you and I kind of look at the world similar ways, and there are reasons I don't want to get into exactly in this room, but you know, I don't want to do these rooms all the time. Like, it's just there's such a thing as overkill, and also I've got to have some increasing calls in my time during the week. So right. I wanted to ask you, like, what would make sense, like a room on a Saturday morning, and then like maybe one day during the week, or you know, like, because I get people really like these rooms. It's not because of my brilliant personality. It's just we got really, really smart people in here. Yeah. But I just look at this room today, and you know, I'll exclude present company, but just look at the room right now. You got, from the top down, you got Michael K, Abe, Bobby Justice, Marathon, Billy Warbucks is a big guy. Shrub, we raise your hand. I want you to get up here. I'm not gonna let you get out without you talking. All right. Yep. Amy's hiding. You know, Three Aces was in here. I mean, this is just to me, this is just mind-boggling what we're able to achieve here. So, here, you're a focus group of one. And by the way, Abe, you speak up. Anyone speak up. What could we do a little bit differently, or what suggestions might you have for how we might format things differently? Anyway,
I would just say this, George. You know, one of the things is I hop into these spaces periodically throughout the week. Most of them are dialed into one specific topic. Sahib, you know, I've known him for 8 months now. Fantastic kid. He used to get a lot of shit last year, you know, for just talking about energy all the time, just nonstop. And of course, now his rooms are fantastic for people that want to learn about energy. But I got to say, your rooms specifically are fantastic because it's not just talking about one specific topic. We cover a lot of bases, which I think is fantastic. People need to kind of step away from the echo chambers, bring in some some folks that are, entrenched in areas that, maybe we're not looking at. So I love the fact that you get a lot of people in here talk about technicals in the market, talk about trading, talk about, politics, talk about whatever, it's fantastic. So I just wanted to touch on one thing real quick, and I haven't heard a lot of people talking about it. Just, recently it's come up, but fertilizer stocks. I was just reading last night. There was an ag report on one of the rags that I subscribe to. The Russian ministry recommends to halt fertilizer sales out of Russia, and which is one of the reasons why fertilizer stocks this week had just taken off. I mean, Mosaic's at a multi-year decade high now. I mean, it's incredible. Fertilizer is Russia produces, I think, about 13 to 15% of the global supply of fertilizer, potash, nitrogen, and so forth. And, everything's been kind of shut down. No exports leaving or coming into Russia. Now, if this thing gets resolved in a week or two, all bets are off. If this thing lasts for the next 6 months, a year, if this war continues and it's, unresolved, food prices have already been going up. They're going to go up probably a lot more. And so crop prices are going up. I mean, you're looking at wheat, limit up literally every week. I mean, soybeans, wheat, just everything, corn. So this has implications literally globally. I mean, it's pretty crazy what's going on in fertilizer industry. And if anybody's out there that hasn't had a chance to take a look at fertilizer stocks, because it's kind of like that arcane kind of backwater-ish type of thing. I mean, Nutrient, for instance. The other thing is too, a lot of these fertilizer companies have been consolidated over the last 15, 20 years. Nutrient, that used to be Potash and Agrium. That's a stock that we own. That's a fantastic company. So I just wanted to throw that out there, that I think everybody's talking about energy going up, prices, gasoline and jet fuel and whatnot. But I think more focus is going to be on food prices and on the fertilizer space. So I just wanted to throw that out there.
100% O'Hare. Yeah, you're right. We haven't talked about it today in this room, but this has come up a lot. It's all related to the energy thing, and it's just, I mean, listen. Again, I'll repeat this. I posted it, I think, go look at my Twitter feed. Let me see if I can put it back up here. But you gotta watch this video from this Peter Zahan guy, and he's talking about, it's not just the energy, but the food and everything. It's just, I mean, like, I didn't want to get out of bed this morning when I watched this thing. I tweeted out. Let me just find it here. If one of you guys wants to throw it back up on the nest, have at it. I don't know how to do it. I'm not too good with this stuff. But I tweeted this thing out this morning. Where are we here? Here we go. From Peter Zahan, and I tweeted this out 4 hours ago, and it's talking all about how things. It's a great video. It's 30 minutes long. I'm going to retweet it right now so you all can see it. But I urge, run, don't walk, to watch that video, because it talks about a lot of the points that you touched on here. So really good comment.
Yeah.
Appreciate that.
Yeah. And then last thing, I would just
Yeah.
say one last thing, George. As far as like your rooms, I think a lot of guys like me and a lot of people in this room, we're professionals. We work during the week. So it's hard to kind of sometimes hop into these rooms while we're at the office. But if you wanted to run a room on a Saturday morning, I think that would be a fantastic thing. I think we get a lot of people that would join in and a lot of good conversation, like a Saturday morning, or even maybe a Sunday evening room, something like that.
Yeah. So this is a Saturday morning room. So I think I want to do one on a Saturday or a Sunday, maybe like there. And I think 11 o'clock is a good time, because you can still catch the European guys. And okay, if you or Three Aces got to get out of bed at tough titty, you got to be up at 8 o'clock. The problem is when he yells at me, he wants it later. I'm like, yeah, but then you got the poor guys in Saudi Arabia or in Russia up at 3 a.m. You can't do that. So you got to put your body in line. If you can't get out of bed for 8 o'clock call, I'm sorry, I can't help you. But
right.
But I think 11 a.m. is kind of the sweet spot, which is great for the weekends. And the questions during the week, I've been doing them after the close, but then you start to run into problems like when Michael Howell's, you got to get him at 9 or 10 o'clock. So I don't know. I mean, I think the weekend's an easy one because people have more time. And so whether we do one once a week or twice a week, they've been kind of ad hoc, but we kind of created this monster here, and we get so many good people coming. It's like, I want to keep it going, but I want to do it in a more intelligent way. So any suggestion anybody has, just
like a weekend recap, like a week recap. You know what I mean?
Yeah, which is kind of, I think, what we're doing here today. So it's great. So
fantastic. Yeah.
All right. Appreciate that, here. Thanks very much. All right. So
hey,
now
George, can I say something real quickly on a Mosaic? So we saw last year that the modern market structure is a little bit different than the legacy market structure with options, and there was a massive option plays on Mosaic, among others, or Oxy Petroleum. So there's a potential that certain stocks get memed way up. I don't know exactly how this plays out, but definitely worthwhile looking at option flows. So there could be some complete disentanglement from true valuations because of that.
That's a good point. Thank you. That's great. All right. I want to do, let's see here. Marathon, if you got a quick follow-up, and then I want to go to Storm. Marathon, you got a quickie?
Yeah, just a real quickie on the fertilizer markets. It's an area of considerable interest for us. One of the things that, even if you resolve what's going on in the Ukraine right now, what we've really broken is the ability of the existing nitrogen fertilizer producers in Europe to trust their gas supply. You can resolve this short term, but no one is going to invest or even run a fertilizer plant that needs natural gas as a feedstock in Europe, because you can't trust the supply. So I think it's going to cause incredible disruption to the ability to do that. And nitrogen fertilizer is different from some of the other ferts. You can't skip a year. And so that to me within the fertilizer space is probably the most attractive.
Thanks for that, Marathon. Excellent point. All right, we're going to do Storm and then Portfolio Hawk. Storm, what's up, man?
Hey, what's going on, George? Hello to the room. I posted up in the nest the tweets you were referencing, and then I also put one up there on Microsoft and kind of zoomed out on the chart. And they're a $2 trillion company, and I don't know. I got question marks on Microsoft. Push back a little bit on Stan. I mean, if you made a $68 billion acquisition for Activision, my question would be around innovation. Do they really have it, or do they have to reach out and acquire other companies? And as far as Office, it's been around a long time. Yeah, people use it, but it's more
Yeah.
of like a commodity utility. I don't really foresee anyone paying more for something that's already established. But
Yeah, Storm, if you don't mind, we can maybe do a more technology oriented room another time. I let Stan do his thing, but as you know, I try to be a benevolent dictator in running these rooms to keep it on the straight and narrow. I don't want to go down a technology rabbit hole right now. So if you don't mind, love you. But if you have something else you want to talk about, that's great. I just don't want to get in. Then we're going to get into a whole food fight about the Activision thing and why they're doing it and why is the deal going to go through or not go through. I don't want to do that right now. Okay. So, if you want to come back to something more consistent with what we were talking about in the overall rhythm of the room, or some other topic, have at it. I'm always keen to hear from you. I just don't want to do Microsoft and technology.
yeah, no, I'll just end on this note. My suggestion would be, Saturday, Sunday, I like getting in for a few hours with you guys and listening to a lot of the, tenured professionals and getting insight into the disruptions that we're witnessing. I'm short the market, and my mentality is along the lines of, this is .com times 2, and we just haven't seen the whirlwind that's to come. And maybe a Wednesday space to kind of like midweek, recap. Maybe Wednesday might be a good day to just kind of catch up as things are unfolding in the week and wrap up. That would be my
Yeah,
suggestion
Storm,
for
let me
the
ask you
room.
one question. Does it matter to you, and this for anybody on the stage right now, this is actually productive. So we've had a tendency to do sessions like Tuesdays and Thursdays at 4 and then one on the weekends. It's generally the pattern it's been. Does anyone have an opinion whether it matters whether it's 4 in the afternoon or like 8 o'clock at night? Does anyone have a view on that Eastern time? Do you have an opinion, Storm? Do you care?
I think for a lot of the professionals, they're watching the market, so they're in tune. So after the close is definitely, but supper time's different for everyone else. And like you said, the guys in Europe and overseas. So I mean, I totally
Yeah.
respect what you're trying to accomplish.
Yeah, so it's a mess. But I think the one thing we agree on is that the Saturday, Sunday morning, 11 o'clock is a good slot. And my preference is kind of for Saturday, but that's just me. So it also
Yeah,
depends
Saturday's good, George. I agree with Saturday and 4 o'clock because of any European guys, and also at some point in the day you want to just stop thinking about the market.
Yeah, so maybe we just do it like Saturdays. Saturday. I've generally been doing one on Saturday, Sunday. Saturday 11 or Sunday 11. Saturday is my preferred day, and then maybe one during the week at 4 o'clock. Because the thing is, there's no shortage of demand or things to talk about. Everyone wants to do these rooms. I got a life though too as well, so I have limited bandwidth for this. All right, appreciate that, Storm. All right, let's move on. So we're doing Portfolio Hawk and then David. Portfolio Hawk, what's up?
Hey, George, long time. Glad to be back on here. So, I'm going to take an unpopular view and opinion, and let's see what you guys think. I'm going to make the point that the oil trade might be over. And the reason being, we're looking at a note. I looked at a note from JP Morgan describing two scenarios last week, one with oil at 120, the other at 185 plus. Now, in the face of the price rise we've seen already, what does demand destruction look like, coupled with the fact that travel likely is also going to see a slowdown in Europe and on the Eastern Bloc, and presumably to some other parts of the world, as well as a ripple effect of what's happening with the wartime situation. Now, in addition to that, if you comb through some of the numbers at a macro level, the U.S. accounts for about 20% of the consumption in oil globally. Maybe I'm off by a few percentage points. And then the rest being, not really many of the Western nations, with the exception of Germany, that comes a little farther down on the list, rounding out the top 10. With that being said, Japan, that has already declared that they're not going to invalidate their contracts to buy Russian oil, as well as demonstration from taking a stance from India and China. Presumably, the Russian production stays online and gets absorbed from different parts of the world. What's going to cause oil to go up to 185 in the absence of oil production going offline completely in Russia?
I'm sorry. Could you I just black out for 1 second? Could you I heard everything you said except what is the question? What's the punchline? What's the question?
My question is, in the absence of Russian production being isolated from global markets completely, what is going to be the factor in the face of deteriorating demand that gets us to 185?
Okay, so the reason to have been, and to continue to be bullish on energy has nothing to do with Russia. Russia has obviously been front and center, and it's kind of stolen the show late. And there probably been some tourists that have jumped into the sector and pushed up prices. And maybe if we get a JCPOA settlement or something, peace breaks out, price will come down, I have no doubt. But that's really a short-term consideration. The reason, though, to have been bullish on oil, and the reason it's been going up, for a couple of years now, is because of the fact that we've had a massive amount of underinvestment, and excess reserve capacity has fallen to maybe only 3 million barrels in Saudi. And, companies are not replacing the oil that they're producing. And we're basically going to run out of excess capacity maybe by the end of this year, the way things are going up, if you follow the stuff from Mike Rothman and some of the other leading analysts in the street. And Mike Rothman is the best energy analyst that I know of, and I tend to follow what he says because trying to forecast oil prices is usually a fool's errand. Now, having said that, oil's obviously economically sensitive. I'd like to point out, though, that over the last 50 years, the demand for oil has only gone down 3 times. We had the pandemic, we had the great financial crisis, and it was one of the recession. But usually, what makes oil go up and down is not the demand side; it's the supply side. And as I said, there's been a 70% reduction in capex in real terms in the last 8 years. You've got 4% depletion, roughly every year on 100 million barrels. So you have to keep drilling just to sustain production. So that's really the argument. Now, we get World War III, we get a recession. Yes, demand goes down, blah, blah, blah. But so, but again, oil demand tends to kind of be like GDP, minus a little bit every year. So, if you're going to say to me that, hey, we're going to have a big recession and oil demand is going to go down as a result, yeah, fine, I get it. But that's really, I think, one, I'm not sure everyone agrees with that. And then 2, it depends, how big a recession you're looking for and all on that. Because oil demand, much to Kathy Wood's horror and surprise, is now back up to and through 2019 levels. And will continue to grow for the next at least decade, regardless of what happens with electric car sales. So, yeah, of course it's cyclical, but it requires a pretty big recession, I think, to dent demand sufficiently to cause the price to go down. So I don't know. That'd be my answer. I don't know if anybody else on the stage wants to contribute something different.
So I agree with everything you've shared. And I've been on spaces that you've hosted with the Canadian oil mafia and, the bullish story, excluding Russia prior to this happening, right? And so my thought is that would have been good and dandy, but given the steep increase in price and taking into consideration to bring a rig online and producing is roughly a 24-month lead time. If in the absence of the next 24 months, prices jump so much as a result of this conflict, do we see such an erosion
Portfolio
in
Hawk.
demand and destroy demand to the point?
Portfolio Hawk, I don't know if you're in a car or what, but you keep going in and out.
I'll try to do it again. I am in the car. What I was saying was that I've been in your spaces with Canadian Oil Mafia, and I'm on board with the story and the narrative about why oil is bullish. But are we going to see such a precipitous rise in the price of oil as a result of the global political conflicts going on? The lead time to bring production online is roughly 24 months. And as a result, if we see oil in the short run going to 185 or 190, do we see enough demand destruction to make a case for the capex not being done by the producers?
Yeah, well, Portfolio Hawk, if oil goes to 185, like, I think if oil goes up, maybe if it goes up so fast, people worry about a recession, maybe the oil stocks won't work. But I'll just tell you this: if oil goes to 185, oil stocks are going to have to perform anything else in the market. That's for sure. So I don't know. I kind of question. It's so good, it's bad. It's kind of the scenario you're making up. So I don't know. Why don't we pick that up in another conversation? Because I'm getting tired here. We've been going at this for 4 hours now. I'm going to take a couple more questions, and that's going to be the end because this is enough. David, did you have a question?
Yeah, if I could figure out how to turn on my mic.
You're on now. We got you.
Yeah, hey, thank you all. And George, holy mackerel, what a great mod and you've been, and what a master class. It's almost like just a sequence of master classes. I really appreciate you let me share a few thoughts. This room inspired my, just using the hashtag fog of economic war. I'm a boomer. This whole past week, I don't know if anyone else has been sleeping. My father worked at the test site for decades to help the free world test the nuclear bombs. He actually contracted a couple cancers, so as did upwards of 1,000, like 31 cancers. There were some heroes that were kind of invisible with regards to who we lost. And so my question has to do with just this point in time, and the sheer expertise in here has just been phenomenal. And the pandemic taught us about our interconnectedness. We dropped the balls in so many ways, but I guess we've had some successes as well. But coincident this past week with everything that Putin's been setting forth and starting to catalyze is the IPCC report with regards to the degradation of the climate, and so the impact on our natural resources. And we're really late on that game. So my question has to do with, given the perspective and the history of the 20th century, my context on this current altercation is that this is kind of the last grasp of what communism did in terms of trying to subjugate, human spirit. You had the USSR, you had the Cold War, and then now you've had the rise of Putin, who was a student of all that. And so we're going to have to likely go through all of this again, which means, take a big breath. This could be several years. It's going to escalate. It's going to be several years to work through this. And, the fertilizers, all these different specific, flashpoints are like lighting up my mind. But my question is, if any of the experts would like to share just some thoughts with regards to if this, or as this, as I would choose my words, as this emerges to be a multi-year chapter in world history, if you wanted to just share some thoughts on that, touching on the natural resource degradation. Thank you so much, George, for allowing me to share some thoughts.
David, I'm sorry, but I'm probably not going to give you a satisfactory answer because we've been going at this for 4 hours. I don't know if you were in the room back then, but we talked about why this is going to be a long, drawn-out thing. And so 3 Aces was in here.
Thank you. I understand, George.
And some others where I can't remember who it was. I'm losing my mind. I got to get some more caffeine. But the sense was this is not going to – the world's profoundly changed, and this is not going to go away quickly. So, I cannot offer you a positive answer to that question. I don't know if anybody else wants to take a stab at it, but like I'm kind of fried right now. So, anyone else want to say anything on that? If not, David, we have to ask the
Thanks,
question
George.
again.
Appreciate it, man. And the room's been awesome. Totally retweeting it. Thank you, sir.
Thank
Well,
you.
George, I would just quickly add that I think Stan or somebody had mentioned that some of these equities, like for instance, I think you mentioned Mosaic in particular, could be overstretched. If there's some kind of a meme-ness to them with options and things. Look, the reality is most of these stocks are trading at below, in a lot of cases, half the S&P multiple. So S&P multiple is just north of 20. NASDAQ multiple is north of 25. Even now, as earnings are coming down, you have earnings revisions coming down now. So a lot of these natural resources plays, not just fertilizer stocks, but energy stocks and any ag-related names. A lot of these things are still trading at multiples not seen in many, many years, in some cases decades. So I would just say we're kind of in this first, second, third inning of this. And by no means these things are expensive. So if anything, these things now, could there be price corrections along the way? Absolutely. You can see that, like you saw that in energy names, right? They can go up a lot and then they come back, retrace at 25%.
Yeah. O'Hare. Again,
Yeah.
I think we covered a lot of that earlier too. So I don't want to get into that's. I love you, man. I don't want to be rude, but it's just we're going over old ground again. So I don't
We
even
need to
want
go
to
get you a coffee, George, or maybe
I gotta get a coffee.
Bloody Mary,
Yeah, I want to stop. So, all right, Michael K. I gather someone hit a nerve. Maybe it was me. You're back in the room, Michael. What do you want to say?
Oh, just want to make a comment just on the prior speaker talking about the valuation. So yeah, the multiple is now down to about 18.5 on the S&P, but it's also important, I think, it's worthwhile looking at the equal weighted multiple as well, which is down to about 16. So we were at 24 2 years ago on the market multiple. Started this year at 21, now down to 18.5. But again, there's about a 3-point spread in the equal weighted to cap weighted difference. And just for context, back in 2000, that was about a 12-point spread. So, I know a lot of people like to make similarities to 2000. There are some, but there's also plenty that are not. But the market's definitely nowhere near as expensive as it was back then, even from the most expensive to the average.
Thanks for that, Michael. Appreciate it. All right, we're gonna bring this room to an end in a second. So we're gonna do. There's a couple people that haven't spoken, and that's gonna be the end because it's just I got just saying it's enough already. I've done more than my share I can afford. So we're gonna do Jeffrey, and then we're gonna do Arthur. And if anyone else has any questions, raise your hand now. That's gonna be it. So Jeffrey, what's up?
Jeffrey, yeah, thanks. I jumped on this a little late, so I don't know if you guys went over this topic. Can you hear me?
Yeah, what's your question, Jeffrey?
Yeah, I don't know if you guys went over this, but what if this Ukrainian Russia ordeal keeps going for months and months? Is there any political will with this administration to open up the spigots? Did you guys already discuss this? What kind of tools do they have? Do they have the will?
No, I don't. Honestly, the Canadian energy oil mafia is not here anymore. So I think I wish you'd come in a couple hours earlier. But we never even talked about it because that's not really a realistic thing. So, but I would say there's always the Canadian oil mafia is always always present in these rooms. So be sure to bring that question up in the next year if you don't mind. All right, so I'm going to bring the room to an end right here, unless anybody's got anything else to say. Because again, 4 hours and 10 minutes, which is I don't know. I don't think it's my magnetic personality. I think it's just the markets, and there's so much to talk about. What a pleasure, Bobby J, Michael K, O'Hare, Portfolio Hawk, Marathon. Amy, you didn't talk, but whatever. We'll get you next time. Storm, and all the people that aren't here anymore. An unbelievable room. I'll post the replay. We'll do it again. Never a dull moment. And everyone stay safe, and we'll see where it goes. Take care, everyone. Bye-bye.